I'd like to begin. 2:05, Kathy? Calling the meeting to order, 2:05. Okay, the first item is approve the minutes of the meeting of March 5th.
I would move them.
I second.
Discussion? All those in favor?
Aye.
Approved, okay. The next item, Tom Marion, updating on contract 6740, Town of Greenwich and PKF O'Connor Davies, audit reports.
Hello, Tom.
Somebody suggested 30 copies would be sufficient, so.
Does everybody up here have a copy?
We all got it by email.
But not as glossy as that.
I'll take a glossy
I
copy.
would love a hard copy. But
Yes. And I hope I spelled everything correctly. That seemed to be a challenge to me.
Okay, Tom, if you give us an overview, and we can briefly, if we have time, discuss your recommendations.
Sure. Obviously, the assignment was to convert or prepare a financial statement that is a different model than the town records. The town keeps its records. Both of these reports use GAAP, but the town keeps its records on a GASB basis, Government Accounting Standards Board principles. And the goal was to convert the town's type of format to what I guess I would call a commercial model, which was a GAAP using Financial Accounting Standard Board principles. The town records, they're kept on the modified accrual basis of accounting for this fund, and that's more or less a cash flow type report. It focuses on assets available for the next 12 months and expenditures for the next 12 months. Capital expenditures are shown as an expenditure in that report. Debt payments are shown as an expenditure in that report. So it is a completely different model than the commercial model. To convert to the commercial model, we sought out and understood what the long-term assets are, and that's obviously the building and the equipment. Again, on the town's records, they're shown as expended. On a commercial model, they would be shown as assets. So historic data was looked at to come up with the total assets to be recorded on the financial reports. Similar as to the debt. The debt was how much of the long-term debt is assigned to the withdrawal. And we then converted the town's records by, and this is a simplistic discussion, but by adding those items and including them, we did, though we didn't formally report on 2016, because we were doing a review process, we wanted to have at least 2 prior years to the 2018 year. So we sort of, once you were in the process, we really rolled back to the end of 15 so we could have a 16 set of numbers that we had comfort in, and then we could have 16, 17, and then 18. We had to choose a format, if you will, to prepare these financial statements. The model that seemed to most fit was patterning these after what a nonprofit organization would use versus a commercially owned organization where there's a stockholders and that sort of thing. There's a slightly different format for a nonprofit presented financial statement versus one that's for a commercial, though the basic premises as to how you develop the assets, the liabilities, the equity, the income and expense would be the same. It's mostly a format issue, but it seemed that a nonprofit format most closely fit what we have here, as there is no stated owner. We did, as we developed this financial, in obtaining some of the numbers, noted certain what I would call corrections that needed to be made to the town's records. These were principally in the area of billings and proper either allowances against those billings or pending adjustments coming in that contemporarily you'd like to try to record those as they occur rather than let them all flow at the end. So we made some corrections for everything else we did was more or less taking data and putting it in the right formatting, adding it and rolling it forward, we did make some corrections in terms of both how the revenues were presented at the town and as how the accounts receivable and the allowance for, and some allowances off of those accounts receivable were presented. Is there, you want me to kind of walk through the balance sheets and things themselves, or? Yeah, okay. So the report has a traditional format. Second page is our independent accountants report. And as I walked up here, I heard the word discussion of an audit. We actually didn't do an audit. What we did was a review, and a review is an analytical process where you have some expectations based on the industry. An expectation would be, what is Connecticut doing with Medicaid rates? Are they increasing them? Are they decreasing them? What's going on? And how would that expectation relate to the financial statement? Plus, you compare numbers statistically to the prior year numbers, hence why we sort of rolled back to 16 just to get a good platform for this. So, the basic report discusses the process we did, and again, it's very much an analytical process, not an audit process. But the way that sort of process works, if you have something that doesn't make sense to you, you end up digging down into it. The difference is we didn't vouch various records and the types of things that go on in an audit where you're pulling invoices and selecting them. We may have looked at them just to get to the right accounting. Page 2 is the statement of financial position. That's a nonprofit term for the balance sheet. If you had the town's presentation, you would notice that there are no capital assets included on that. That was the cash and accounts receivable. For all intent and purposes, are accounted for the same. Capital assets is a big adjustment we made in preparing the financial statement. So you can see the assets, the liabilities. The town's records include the accounts payable and the accrued expenses. The long-term liabilities in regards to the health care plan, the pension plan, the funds advanced by the town are not recorded on those statements. So those are all additions we made here. At the end, we have the net assets, which is the version of equity in this nonprofit model. We have an unrestricted designated net investment in capital assets. That's basically the value of the capital assets, the real estate and the equipment, less the long-term debt. That's, in a sense, a board-level decision to designate that as a subset of net assets. The actually unrestricted net assets is a deficit. At the end of 18, it's a $10,949,698 deficit, leading a total net assets of roughly 1.7 million. Next page is our statement of activities and changes in net assets. That's again the nonprofit model version of an income statement. The goal of this format was to clearly segregate the operating results of the Witherall from any other activity that may go on there. For example, the pavilion property is shown, or the revenues and expenses are shown independent of the actual core operating numbers of the facility. It was important to drill into to know exactly what that is. You can see we have resident service revenue net of allowances. That's the income side for the facility. Now that's meaning what the term contractual allowances, it's net of those items. So it's intended to represent what you expect to receive for providing a particular service depending on Medicare, Medicaid, private, ancillary, et cetera. You can see that, again, the direct costs, and they are grouped by sort of the traditional categories: resident care, dietary, housekeeping. We do put the provider tax up there because that's a direct add-on to the Medicaid rate. They increased, when they put the provider tax in, actually increased the Medicaid rate by the same amount. So it's kind of an odd direct cost, but it does vary directly by the number of rooms sold. And then laundry, the indirect costs. And the direct costs, for the most part, you might consider them somewhat variable. The more busy the facility is, the larger some of those costs will be. The less busy, the less those costs would be. The indirect costs, again, you can see at administration, maintenance of plant and operation, interest, depreciation, and insurance. Depreciation on the building and the equipment. Oh, we are. On this version, we are. So I'm saying that was a big addition to what the town had, is to include those capital assets. Then this is the related depreciation of that. Yeah, okay, yeah. Oh, okay, yeah, under the, the second sort of batch of data. And what we, again, did here is segregate these other, if you will, not directly associated with operating the facility. And I think you can see there's kind of a shopping list of various things in there. The big numbers, as asked here, was we have two accounts, the pension liability adjustment and the retiree health care liability adjustment. And this has to do with basically funding. And of course, the Witherall doesn't have a separate plan of its own. The employees, and either there's a health care plan, and there's a pension plan that certain employees of the town, everybody is in the health care plan, but the pension plan has been sort of phased out, so not all the employees are in that. But there are some employees at the Witherall that are still in that program, or are retirees out there collecting on that. So what we segregated is the cost, the normal operating cost for the year. That's shown in the costs up above as part of the ongoing operations. And the assumption is that if you really took that sum of money and funded it each year, there would always be enough money in the program. It's an actuarially determined number. I don't know how they do it, but they have their way of doing it. The actuarially determined number that if you fund that, there should be enough money in the program. However, they have to make certain assumptions to get there. Investment return, and how the population reacts. If people retire and take a lump sum distribution, well then more assets come out maybe faster than they thought they would be. So the bottom part here then is that sort of difference in the funding. And it's pretty clear from at least my observation of the records, the town has been in an aggressive mode of trying to get the programs fully funded, because there's the liability, and then there's the amount that is assets escrowed in the trust. They're in a separate trust account, and they're pouring money into that trust account.
Is that why there's such a differential between 17 and 18?
Well, no, because actually the money's being funded into the trust account don't show up here because they're not an expenditure. They're accounting for past service costs.
Legacy costs.
That money hadn't been set aside years ago. So it's part of a catch-up provision. So this is more, there's basically two things that go on here. Is the change in investment assumptions and any change in the actuarial assumptions. And it's just how if you look in the town's report, you would see this whole, this basically mirrors how that's presented there.
Yeah, okay, thank you.
Yeah, but it's predominantly funding. In good years, it's a plus. In bad years, it can be a minus, especially if the date of the calculation happens to be a really bad time in the market.
So you're saying normal cost is up above?
Correct.
So this is,
Legacy
we worked on
costs.
this in the pension plan, obviously. Demographic changes, a bunch of people die or live longer, investment returns are higher or lower. But are we saying the funding of the catch-up to the underfunding, is that in here?
That's not in here. That
That's up above.
would be, if you go back to the balance sheet page,
It'd be up above.
yeah, you see that we have a net liability for the retiree health care plan.
Yep.
And a net pension liability. That is the sum
Normal
based
cost
on
plus
all
the
of these
catch-up.
calculations.
Okay.
That's unfunded from prior years.
Okay.
And
Legacy.
But you can see, for example, if you look at the net pension liability, it went down almost $1 million. That's just the town's decision to try to catch up on this funding. At some point, that would in theory be zero.
Okay,
And
thank
every year they would calculate what you need to keep it at zero.
Thank you for that.
Yeah.
Could I ask another question while we're on pensions?
Sure.
When you look at, just so we fully understand, on footnote 9, you've got the pensions. And there you have the figures for the whole town, $600 million valuation, $500 million of assets, $100 million of underfunding, but that's the whole town, right? And then we say at the top of page 13, that the liability of the Witherell is $4.9 million. So is the right way to think about that, that $4.9 million is, you know, call it 5% of that $104 million from the prior page. And that's, given the logic, it's like saying, we're 5% of the whole. It's as if we had 5% of the liability, 5% of the assets, and the difference is $4.9 million. Is that the rough way to
Correct.
think about it?
Correct.
Okay.
And that factor, the percentage, was based on a separate small actuarial report of the population at the end of 18.
So when we say the liability is 4.9 million, that includes an assumption, however, as if the Witherell had 5% of that $578 million of pension fund sitting out on Parsons Road, you know, as if we had 25 million in cash there. I know we can't double count it. If we count it at the Witherell, we can't not count it in the town or whatever, but
Right.
when the real liability for the Witherell is $25 million, but we're saying 20 million of the assets is allocated to the Witherell. And the net difference is -5, right?
Though I look at it slightly different in the sense that the obligation for those employees is really the town's, because they're
Yes,
employees
you
of the
do.
town.
Yeah.
And so it's, this is a allocation
A
based
slice,
on
yeah.
I mean, as if there was a, you know, sense of call and say, everybody show up and pay the difference. This is what it would look to Witherell to pay. Okay?
Let me add a follow-up question. Tom, so going back to page 3 and looking at the 273 add back for pension liability adjustment, we're adding that back to the Faneuil because, again, as you pointed out, it's a town obligation, right? Where is the number included in the cost above? What line item?
Well, and actually the better page to see that
Okay.
would be the functional expense
Yeah,
page,
page 5.
which takes these categories and shows you
Okay.
the natural classification of them, as they would say, and that, oops, sorry, I'm
It's in
going
the
too far.
benefits line.
It's in the benefits line.
Yeah.
I didn't separate it because we did to provide cost of the various housekeeping, whatever. We took the benefits, and basically allocated it
Got
over
it, okay.
salaries. It's in the benefits line.
Thank you.
Okay, so that's the statement of activities and changes in net assets. The next page, which is always, for me, probably the most important page of any financial statement I look at, which is the statement of cash flows. Because ultimately, it tells you how any organization stays alive. How does it pay its bills? Where does its money come from, and where does it go? You can see it's broken down into 3 categories. Operating activities, that is doing what you do, in this case predominantly running a skilled nursing facility. Investing activities, and then financing activities. Those are the 3 general classifications you always see in these kinds of statements. And for both 17 and 18, operations generated a use of cash. That's why you see it as a negative. That means the operations themselves did not provide cash. It generated a negative cash. The investing activities, acquisition of capital assets, you can see that. That's a investing activity. And in 2017, there was a small sale of a vehicle or something that created that $6,100. The financing activities is, really basically tells you how did the town afford the operating activities, because you can see it's a net positive, and that's funded basically in 18, for example, of, in addition to the funds advanced by the town, that's a liability on the balance sheet on page 2, the category, and we use the same funds advanced by the town of Greenwich. You can see it went up. Well, there shows you that's how the operations were funded, plus a contribution by the town of $2.7 million. So any questions on that one?
So what is the difference between funds advanced and a contribution by the town?
Classification.
Okay.
Both sets, the funds obviously came from the town's general fund into this fund, and it's accounted for that way. The contribution is an amount that was, I think, labeled on the budget as an amount that the town is going to contribute into the Witherall to help cover operations for that year. The funds advanced is basically all other funds that went in to cover operations. Now, my history of looking at the financial statements are about 4 years worth of data. About 3 years ago, the town did take that funds advanced by the town and then convert it to a contribution. So in that particular year, the liability went down and the contributions went way up. You might consider the funds advanced by the town kind of like a line of credit. Mm-hmm. Mm-hmm. They would be included in that funds advanced by the town.
I got to follow up on that. You said it includes in-kind activities, but in my mind, that's not a cash flow.
I understand that, though I think the intent was it to be for something to be paid. So, I mean, there's a series of items that the town funds and actually puts the cash out. I understand that. You could make that argument, but historically it was intended, it was something that was billed. And what makes this a bit confusion is everything runs through that intercompany account, if you will. A lot of the day-to-day transactions run through there. I mean, that's a valid point. You could make that argument. I did not treat it that way because I assumed if the resources were there to pay it, it would have been paid. Yeah, so that's why I did it that way. That it wasn't intended never to actually be paid. Mm-hmm. Right. And just kind of going through this and kind of to speak how this can be just a bit confusing, you take the retirement of the long-term obligations. In the Witherall checking account, they didn't pay that. The town paid that. So it was a cash transaction, and that's one of the balancing items of the money being advanced by the town is how that came out, though it was a cash transaction. Yeah, it's the net of these because the net pension liability adjustment and the net liability from the retiree healthcare, that's all coming from the town funding down the deficit of the whole plan. So it's more like the 3.2 million. Yeah. Yeah. Well, you kind of have to do the net because, again, part of what went into the funds advanced was the payment to the pension plan. It didn't come out of the Witherall books, so in that conversion, I had to increase that funds advanced by the town and decrease the pension liability because that's what happened. So I think you do have to look at that net number, which is about a $3.2 million number in that particular year. And you can see 17 and 18 does tell a dramatic difference between the two. Some of that has to do with the collections of accounts receivable and those kinds of things. When the receivables slow down, there's less cash flow generated. Pay the bills, it's got to come from something else. Yeah. Though that, I think, was predominantly tied to the renovation project that was going on. Because what sort of happens is those things are bonded, they get put in here. Sometimes they're not quite as a direct link as they would be in the commercial world, but that particular case it was. The capital improvement. Okay. How am I doing on time? Go faster? Okay. So cash flow statement. After that is that statement of functional expenses, which translates into what we call natural line items, salaries and wages, employee benefits, direct care contractors, and et cetera, to the various categories we included them on the front page. I think that's pretty self-explanatory. And there's one for 16 and 17. What follows are the notes to financial statements. They intend to help the reader understand or provide clarity, especially if there's different options as to how to properly do GAAP, and you explain which one you used. So there's a little bit of an expanded sort of history of the organization as well in here. And again, I think they're pretty self-explanatory. They go through, and a lot of these are required disclosures. We're supposed to say certain things. How do you do allowances for doubtful accounts? And there's also categories called subsequent events and those kinds of things, because we inquire, is there anything that's happened after the end of the fiscal year? In this case, it was June. If there was something good, you don't put it in there. If there's something bad, you put it in there to notify the reader. So these are all sorts of required disclosures, and often what you see is it's basically a small table giving more detail to the numbers on the front page. It's sort of a drill down. Not really. I mean, these are all giving you specific, for the most part, specific data connected with the items on the front page. There's nothing in here of an alarm. We did not have a contingency. That's something like having a big lawsuit that you might have a big potential of losing, especially if it's not covered by insurance. And these are intended. Those kind of disclosures are intended to tell the reader, hey, this may be what it looked like then, but things are not the same today. We do not have any of those kind of disclosures. The rest of it is basically explanatory. Okay. We also have a supplemental information, and this was a breakdown of the revenues, direct costs, and indirect costs of the Nathaniel Witherall, just limited to that. Doesn't cover the pavilion or any of these other ancillary type of revenues, to get an idea by a profit center approach as to what the revenues and expenditures are. There's a series of allocations. Some of them were done based on billing. If you're billing physical therapy services, then that relative percentage of the physical therapy costs were assigned to that category. Others of them were done per day, especially sort of common costs, housekeeping, and et cetera, were allocated based on the per day manner. And you can see the results there. We did that for 18 and 17 as well. I don't know if there's any questions on that schedule. Okay. I sort of had a unique position in that I worked on the financial statements, so that conversion process, but I also have worked on doing the Medicaid and Medicare cost reports over at the Witherall. And I did sort of come up with what I call observations and recommendations based on both experiences. Some are not necessarily directed towards the financial statement. It's more directed towards the operations. I don't know if I can hand them out, or do you want me to, leave them, or? Yeah. There's maybe 20 copies, yeah. Okay, ready? Yeah. And again, these are intended to be a very practical, trying to improve what I think is reporting for all of our functions here. And in my mind, it's financial reporting, it's cost report reporting. One of the things that I strongly recommend is all the reporting should flow from Munis. And that might sound like kind of, why would you say that? But what I have found is certain reports, especially over the Witherall, are an Excel version, and I found that some data sort of got lost as time went on, as it was processed. Clearly, when we did the cost reports for the 17 year end, I started with the Witherall monthly reports, their version of the board reports, and I found some problems with them and ended up digging back into the Munis. And having learned from that experience this year when we did the cost reports, we started with Munis, and you can, being very accountant-like, you can track everything we did to get to that cost report. And if there's ever an inquiry, it'll flow back to the Munis records. I just think that's very important. I do discuss down a little bit further in here. I do think there has to be a major overhaul of the chart of accounts. It creates a lot of problems, and I think also hurts in reporting. I do discuss here briefly special revenue fund versus an enterprise fund. And I've been one to say that I think the Witherall should be accounted for as an enterprise fund, but I have a change in that opinion. And the reason simply is this: an enterprise fund has to be a fund that's managed such that it at very least breaks even. Considering the Witherall isn't at that point yet, it would actually cause problems for the town to switch it to an enterprise fund. This has to do with bonding and all of those kinds of discussions, the way the underwriters look at it, that if we had it switched to an enterprise fund that's losing money, that looks poorly. If it's a special revenue fund that gets support from the general fund or the general government, isn't looked upon poorly. So I sort of reversed that decision. This is a little bit based on having the opportunity to really look at everything. So I wanted to cover that. And again, I can go into further detail on any of this stuff, but I'm trying to keep it moving here. One of the things I also found is we sort of have, and this is under the responsibility for the reporting process, and it kind of dovetails a bit about everything coming from Munis. We sort of have a bit of a disaggregated process. All the billing is done over at the Witherall, and that's done in the matrix system. And then there's a series of journal entries that are sent over to Town Hall. The invoices are processed at the Witherall, but then are paid through the Town Hall. I just feel somewhat in the process, I would find a discrepancy. And this was mostly in the billing area, and sort of no one knew for sure whose job it was to make sure it was done properly. And so I am encouraging that with some other suggestions that the Munis reporting get more robust, and that someone, which I think it should be at the Witherell, because they would know all the moving parts to this, really be, it's, as opposed to saying we generated some journal entries and we sent it in. Once it's sent in, look at it again and make sure you hit the mark and it did what it was supposed to do, so that the reports everybody sees on a monthly basis are actually representing what's going on. Correct. Yeah.
So is it your opinion that Witherell is using Munis effectively, or do they need additional support and training on how to, and does the system need modifications in order to accomplish your recommendations? If you could just be
Yeah.
more specific so that we understand what the next steps
Right, and I
are.
actually have, under chart of accounts, I have a discussion of that, but I'll switch to that right now, because if I had two takeaways that I could get moving forward, one is everything comes from Munis, so that there's never a confusion if we're dealing with a Medicaid auditor where the numbers came from, or a financial statement auditor, or any management thing. The other is, I think the chart of accounts needs to be more robust and basically follow more traditional categories. And I'll give you an example. In the chart of accounts, there's an account that says prior year expenditures. I don't know what that is. I actually do know what it is, but I didn't know from looking at it. All I know is if we sent that off to the state of Connecticut, because when we send off the reports to the state of Connecticut, we send something called a crosswalk. That's a requirement. A crosswalk basically says, here's our general ledger accounts, and here's where we put them in your cost report. They have the ability to look at that and say, well, what is this? So we have to take all those accounts and break what's in them out so that they're in a proper bucket, so that it doesn't look funny. We have all sorts of other accounts that say other professional services, other expenses. Anything that says other or it says miscellaneous, it really needs a home in these chart of accounts. And from the revenue side, I think the revenue lines should mirror what's in matrix, so you really get a good handle on where those revenues are coming from. I mean, it's a changing world. They keep changing these reimbursement systems, how they're doing it, even the philosophy of how they're doing it. Everyone should be able to see that from looking at a report and not have to drill down to a separate report from a separate system. And that's part of what I'm saying is the two don't necessarily, they take that and sort of squish it down into 3 codes and send it into the general ledger via this journal entry. I think you want to be able to look at what's on the town report and be able to look at the matrix system, and you would see the same numbers. It wouldn't be confusing. And with sort of an expanded reporting format, somebody's got to be in charge of saying, when it's all done, I got to look at it and see that we hit the mark when we did it, and that's sort of the responsibility. While I'm on that, I wanted to just kind of go through this little report here. This was what I basically did here, and this is not intended to be a report to track all of the adjustments we made to go from the modified accrual, if you will, to the FASB-based statement, but it was to demonstrate what I think is an important point. First column says fund basis 2018. That's matrix, right? And this reporting works fine, though you don't see these categories in there. Matrix is organized in a different way. Part of, to me, rearranging the chart of accounts is to have within the framework of matrix and how it rolls up into the town reporting, is to have some expanded accounts so you could get this kind of detail. What I wanted to point out is when we did the financials, you see there's a column called corrected entries. We basically did 2 corrections. And the little gray box is basically revenue and billing, accounts receivable adjustments, and we've spoke about this in other meetings, the wage enhancement adjustment that was not booked, and the Medicaid pending adjustment. The little, I don't know what that other color is, but whatever that other color is, number 2, that was, at the time we took the reports to do this financial statement, the in-kind expenses hadn't been recorded yet. So I'm pointing those out as correcting entries that we posted, all right? And then you can see the corrected fund balance. we did in our process, and you can see under benefits allocated, the town keeps track of the benefits all in its own categories. Since we put them into resident care, dietary, and housekeeping, that was a sort of a reclassification adjustment. But the key point I wanted to show here is, if you look at the allocated fund basis, which means the benefits have been allocated to the right account, there's very little difference between the town reporting records and what the FASB records are. The single biggest difference is the depreciation adjustment, which we talked about earlier, is not on on the modified accrual basis of accounting. So, to me, and this is the heart of the operation. This is what you want to manage. This is what the folks at the Witherall need to manage. These are the revenues. These are the expenses. The 69,000 is basically the adjustments for compensated absences. I'm glad I don't have to spell it, because that's been a problem. And a couple of other minor accruals that aren't shown on the modified accrual basis of accounting, but they are in here. And to me, this is very important, and I think there's a lot that could be done pretty effectively to get reporting that, it doesn't necessarily have to follow this exact format, but with expanded accounts and things that give you operational numbers that can be looked at on a monthly basis, as long as somebody's in charge on a monthly basis to really make sure those are right. That really tells everybody what's going on, and you have to start with that, and then that's the basis, is what can we do to tweak these operations and try to improve them. That's everybody's goal. So, again, my next recommendation was in regards to the chart of accounts. I mean, Munis is a powerful system. I don't think there's any limit to the amount of accounts you have to put in there. It has all sorts of ways to accumulate data. It already has certain breakdowns that really actually cover dietary, resident care, and et cetera. It's, the O1s, O2s, O3s, there's different little extensions there. So I think there's an opportunity. It just has to be well thought out, with a goal of getting an operating report that is looked at like every other facility, because that's how the reimbursement models works. That's how you get paid what you get paid, especially on these Medicare and Medicaid. So you got to understand the game and play with that. And having the data in the right format, I think, can be done relatively efficiently. The balance sheet would be a different story. That would still require a similar process that we did to get you the proper balance sheet. But the heart of the operation always is the profit and loss. If that can be managed, the balance sheet will take care of itself. The 126,000. Oh, what we did is there's healthcare benefits, there is a few other types of benefits, uniforms or other types of things, the pension benefits, and there's really the defined benefit plan and then the defined contribution plan. All of that smorgasbord of benefits was not assigned to each individual department. So what we did is we allocated that pool of over the salaries and assigned them to those departments. And my point is, the accounting, the core accounting of it isn't any different in the Munis system as to how we ended up with it. They didn't, you see what I'm saying? It didn't require that. And that doesn't necessarily you could have a category that says benefits and leave them unallocated. It still gives you but there's not a lot of effort to go from Munis to really, to me, the operating reports that are meaningful. Accounts receivable and billing, I strongly recommend there that, and again, as I was hunting for certain data, I found things that I would not label as a best practice within that process. So I didn't by any means sit down, nor am I a billing person, sit down and really look at all the moving parts. I just, from my experience, felt that we had some issues in there. So I strongly recommend that I think it would be money well spent to, A, really see what's in there, B, really make sure you identify best practices, which really should be part of weekly and monthly closing processes that are followed to keep that database correct. And related to that, of course, is collection processes and things like that as balances that are going uncollected. I understand that the town has a formal policy about how you're allowed to write a bad debt off, but you can properly create an allowance for it if you think that's questionable collection. I think they're two distinct calculations here. And well, I would think perhaps it's an outside consultant, simply, and basically you go from, you know, the core really records for billing almost start in nursing, who's in the house, and, you know, what, and they determine their Medicare rates and all of these sorts of things, and how is that filtering its way up the system? So that's the first process, make sure that that's accurate. Then, how are the bills rendered to the various third-party payers? Medicaid's reasonably simple. It's a rate per day. That it doesn't matter who you are, as long as your Medicaid's paying for you. That, as long as the days are correct, you're good. Medicare's becomes more complicated, then as part of that, you would look at the database. Because when I say database, I have an accounts receivable, and we talked a little bit about this. That there's what I would call clutter in there. There's amounts that, when you look at it in the total, sort of disappear. But when you look at each individual, if it keeps going the way it is, you know, you're going to run a report that'll go from one side of town hall to the other with every name on it, because if there's $20 left on it, it's still sitting there. And A, why is the $20 there? And then B, because if it's something you should be able to collect somehow, there's only a certain time limit that you're allowed to try to correct these matters. So, and make sure that you're getting everything you're supposed to get, and not more than you're supposed to get, because that has complications on another level, you know. All right. All right. Thank you. I will. Oh, sure. Yeah. I will. I'll give you a PDF version. Thanks.
We'll move quickly. Absolutely. For sure we'll do that before we begin. Let's see, one more second here. My apologies for the delay. think we're all set, if you all are. Yeah, one second. I think you would prefer, Art, that I introduce the team first before we get started. Is that correct? All right. All set? Great. First of all, thank you all for your time this afternoon. We really appreciate it. My name is Darren Hull. I'm an Executive Vice President with Health Dimensions Group, and I'm joined with three colleagues today. Kathy Carr is Vice President of Consulting for our organization, and she served as the project manager for the work that we did here over the last year. Also joined by Colin Higgins, Director of Analytics and Research with Health Dimensions Group, as well as Stephanie Cyrus, who's our Director of Financial Planning and Analytics. As far okay, sure. To describe Health Dimensions Group is kind of an interesting task because we reside all over the country. So when we actually work on projects like this, it's kind of a reunion of sorts where we can all get together because we're used to working so remotely most of the time. My hometown is just outside of Milwaukee, Wisconsin. Kathy and Colin reside in and around the Minneapolis, Minnesota area. And Stephanie, I believe you reside outside of Tampa, if I'm not mistaken, Florida. So when I heard that we had to get three different sets of airlines moving all in the same direction at roughly the same time, I became a little nervous that there'd be some disruptions, especially given the awkward winter weather that we've had. But we're
Don, are you back there? Do you know anything about this?
that didn't take long. As a brief preamble, first of all, again, thank you for your time. We're so glad to.
So a speaker came on a moment ago that sounded like it was a telephone connection with somebody. Is that something related to you, Don? No. Okay. So we forgive you. Okay, sorry.
My phone is silenced,
Okay.
so it wasn't anything that happened on my phone. As I said previously, just as a brief preamble, I can't believe it's been a year since I was here meeting with all of you almost 1 year ago, and remember the day, the trip well, and appreciate the hospitality again today. Just as I said, a brief preamble, HDG was awarded a contract shortly thereafter that meeting to complete a financial and operational assessment of the Nathaniel Witherell, looking to identify performance trends, looking for opportunities to improve the operations, as well as to provide the committee an analysis of strategic options moving forward into the future. Today's presentation is just a summary of the previously submitted full report, which was submitted on February 26th, as was the presentation submitted on the same date. Before I begin, I wanted to again thank all of you and all the volunteers, all the staff at Nathaniel Witherell that participated in this very lengthy and detailed process. It was very much a full team effort, and we're very grateful for the time and energy that everyone put into the project. Just as a brief overview of our organization, Health Dimensions Group is a full-service healthcare consulting and management company. We've been blessed to provide consulting services to over 700 organizations over the last 18, 19 years. What sets us apart is the fact that in addition to providing consulting services to hospitals and health systems and post-acute providers throughout the country, we are also owners, operators, and managers of healthcare properties ourselves, and operate in multiple states. So we like to think that we come from the school of hard knocks. Not only do we consult, but we live what we do every day from an operations perspective, and we think that's very unique about our organization. Prior to our current engagement this past year, as you're obviously familiar, there were three other prior engagements that we were involved in, one in the years 2003 and 4, completing some financial analysis work for the town, and then 2 additional projects respectively in 2010 and 2011 regarding some long-range planning reviews work that we did. My next comments were to introduce the team, but I think that part's taken care of now. So with that said, we're in good hands today. We've got obviously some technical experts here that all contributed in a significant way to the gathering of this information and its presentation. So I'll turn it over to my team and let them move forward. So thanks again for your time.
Thank you.
Thank you.
Good afternoon. I will be going over the financial slides. There's a couple right now, and then I'll turn it over to Colin and Kathy and probably pick back up later on in the presentation since financial kind of covers a lot of aspects of our presentation today. Slide 4 that we have up right now is just a summary of the business segment and class of payer that are currently at the Nathaniel Witherall. There's 202 licensed beds currently, 156 long-term care, long-term nursing care, and then 46 short-term rehabilitation. They serve 3 primary pay classes: Medicare, Medicaid, and private pay, and of course there's a smidgen of managed care and commercial insurance in there as well. And this is fiscal year end 19 data. There was 27 occupied Medicare beds in this particular time frame, 104 Medicaid, which are primarily in the long-term segment of the facility, and private and other consisted of 48 occupied beds for a total of 180. So that's an occupancy of 89.1%. And slightly half of the Nathaniel Witherall residents come from an address with a Greenwich zip code, just so you kind of get a background of where they come from. The next slide, slide 5, is a summary of the revenue by payer class. Now, as you can see, Medicare, the average rate for Medicare is significantly higher than the other payers. The Medicare revenue for the fiscal year end 2018 was $6.9 million, which was a drop of about $1 million from fiscal year ending 16. And Medicaid has stayed about the same, a slight drop, an increase in private pay of $8.9 million, and then other increased $300,000 for $1.9 million. Overall, this is just care-related revenue of $28 million for fiscal year ending 2018. And now we're going to turn it over to Colin to go over the market area.
All right, hi, thank you. I'm Colin Higgins. I'm the Director of Analytics and Research with Health Dimensions, and this is the third project I've actually worked on with Nathaniel Witherall, so it's nice to be here for the first time. For the next 6 slides, we're going to talk a little bit about the market analysis, and hopefully we'll get a nice summary here so you understand your market. There are 7 nursing homes or skilled nursing facilities located in what we identify as the market area for the Nathaniel Witherall. It's not often I get to say I'm taller than the person that spoke in front of me, so it's kind of nice. Yeah. There are 7 skilled nursing facilities within the market, and on the slide here you can see the overall star ratings in this market are actually pretty impressive, with an average of 3.7, Nathaniel Witherall being a 4, being above average, which is a very impressive star rating here. There are 940 skilled nursing facility beds in this market. At any given time, on average, they're about 86% occupied. We'll talk in a minute here what that means. And then when we look at the Medicaid mix, it's about 2/3 of the market. At any given time, there are about 2 out of 3 people that are cared for in a nursing home bed here are under a Medicaid payer. When we look at the occupancy, 86%, that right away tells us that the market is slightly likely overbedded. An ideal market's going to be somewhere between 90-92% occupancy. Occupancy varies depending on the time of year. Oftentimes during the winter, occupancy might go up a little bit. During the summer, it might decrease a little bit. So there's always going to be some fluctuation of people coming and going, especially in the short-term rehab. So when we see the 86% occupancy, that does tell us before we even do a market analysis to determine what the demand is for overall beds, we know that there's a slight excess number of beds in the market. With one exception, the percentage of residents covered under the Medicaid is greater at each of the other facilities. With the 56% Nathaniel Witherell, again, the market's being about 66%. On slide 7 here, in the map here, you can see the yellow highlighted area is what we identified as the market area. In order to determine the market area, what we do is we look at the zip code of origin. So everyone that is a current resident at Nathaniel Witherell, we take a look at what zip code did they live in prior to moving into the skilled nursing facility. A typical market area is identified between 70 and 80% of where your residents originated from. The remaining residents are typically going to come from near that market area, just outside of that. They could be people that are moving back to the community, originally lived in this area, or they're moving to be near adult children or medical services. When we looked at that zip code of origin, we identified your market area to consist of 8 zip codes. All those 8 zip codes are located within a 10-mile radius, so it's not a geographically very large market. And then 71% of your residents come from that yellow highlighted area on the map there. From a competitive performance, we wanted to take a look at the referral sources. The relationship you have with the acute care hospitals in your market is very important. That's where you get a lot of referrals for the short-term rehab patients. Greenwich Hospital discharges slightly more than 1/3 of its post-acute discharges to skilled nursing facilities. This is a very high percentage. Nationally, the average for Medicare fee-for-service is about 1/5. So that indicates to us right away that Greenwich Hospital is a very strong supporter of utilizing post-acute care services, especially in the skilled nursing. This is a very positive thing for the skilled nursing facilities, not just Nathaniel Witherell, but the other skilled nursing facilities in the market. About 21% of the beds in your market area are actually at Nathaniel Witherell. The primary referral source is naturally Greenwich Hospital, being right here in the community. And about 83% of Nathaniel Witherell's Medicare referral Medicare fee-for-service referrals do originate from the local hospital here. Stanford Hospital is the second highest referral source to Nathaniel Witherell. About 6% of your Medicare fee-for-service patients originate from Stanford. So overall, about 9 in 10 of your short-term rehab patients come from the 2 hospitals. The remaining, a lot of ones and twosies coming from other hospitals, maybe near the area. There could be people that were outside of the area. Something happened, necessitated a hospital stay, and they choose to come back to the market for their rehab stay. Nathaniel Witherell has very good patient outcomes and rehabilitation areas of focus. Bless you. Compared to other skilled nursing facilities in Fairfield County, Nathaniel Witherell has a relatively high market share for rehabilitation after elective joint replacement and major joint replacement and spinal surgery. Another thing we look at when we're looking at the short-term rehab is a majority of patients will return home or to the community after their rehab stay. Not everyone, but a majority of the patients will. In the case of the Nathaniel Witherell, about 78% of your Medicare fee-for-service patients discharge back to the community following their skilled nursing stay. The average in Fairfield County is about 72%. So the remaining people are individuals that may have already lived in a skilled nursing facility, something happened that necessitated a hospital stay, and then they go back for rehab in the hospital, in the skilled nursing facility, which is more or less their home. Or there's someone that was in the community and became a permanent placement in the skilled nursing facility under long-term care after their rehab. So again, to summarize, about 4 in 5 of the Medicare fee-for-service patients cared for at Nathaniel Witherell do return to the community after their stay. This is higher than Fairfield County, which overall is about 72%. There is increasing pressure on capacity of utilization. We will face greater challenges to maintain relatively high capacity utilization and increase revenues due to regulatory changes, projected local demographics, and diminishing utilization ratio. Demographics are always very important to look at. They tell us what the population looks like now. More importantly, what's it going to look like in the future. When we look at the demographics in that yellow highlighted area, what we identified as the market area, there are approximately 157,000 individuals living in that market. Of that, 11,000 are what we identify as age 75 and older. A senior is typically identified as someone who's age 65 plus, but not all seniors, depending on your age, are going to utilize services at the same ratio. Younger seniors, 65, 69, 70-year-olds, tend to not use very many services. We start to utilize more services once we hit 75. And then, of course, once we're at 85, that's where we're the highest users of services. When we look at your market area, the 85 population is a very big area of interest when we're looking at the demographics. We're actually expecting your market to decrease about 4% over the next 5 years. To put that in comparison, nationally, that 85 plus population is increasing about 5.5%. So we're seeing a 5.5% increase nationally. We're seeing a 4% decrease in your market. Again, this is the highest users of services. So when we earlier looked at the occupancy of the nursing homes and saw that was a driver indicating that there's an excess number of beds, when we're seeing a decline in that 85 plus population, who are the highest users of services and most likely to utilize long-term care services, it's a strong indicator that we're going to see an even larger decrease going forward. Sure. When we look at the demographics for the population, when we calculate what the bed opportunity is, what it's going to look like in the future, there's a few things we look at. Not all age cohorts utilize nursing home services at the same ratio. Although it's not a very high percentage, roughly under 15% of people in nursing homes are actually non-senior, non-elderly. When we calculate the number of people that are going to be in a nursing home, we do look at all age cohorts. The utilization is very small when you're looking at pediatrics, young adults, and it increases by age. When we're looking at the overall population in your market, we do want to see how that's changing over the next 5 years. But the biggest drivers for nursing home placement are going to be that 65 or that senior population. The 65-year-olds, again, are going to start utilizing nursing home services at a little higher rate than they priorly had. A lot of times it's going to be the short-term rehab, not necessarily long-term care. And then when they hit 75, we're going to start seeing utilization increase a little bit more. When it's 85 plus, that's the highest users of services. And that's not just nursing home, that's all senior services. So we're going to be seeing more home and community-based services like home health, hospice services, even senior housing, independent living, assisted living. The average age of entry in assisted living is about 80 years of age. So again, even though we identify a senior as someone who's age 65 plus, it's really about 80 plus until we start moving into sources other than our own home.
Let me ask Mr. Norton's question a little differently, because maybe it struck him too, but it struck me as interesting or odd that that you're expecting the cohort that's 75 or over to increase by 7%, I think you said.
Yep.
And nationally, you're saying the cohort of 85 and older are increasing at 5.5%. But there must be something that you're seeing that's the source of your prediction that for Greenwich, or rather the market area, not Greenwich, but the market area, that's not going to increase like the national profile. It's going to decrease by the 4%. What are you seeing that prompts that conclusion?
Actually, when we look at the states is more in line with what's happening in your market than what's happening nationally. So when we look at the state of Connecticut in general, the senior population is not increasing anywhere near the rate that it is nationally. So I would say in your particular market, you are increasing for the 65 plus roughly the same as the state of Connecticut. It is lower than what's happening nationally. But when we're looking at those older cohorts, Connecticut in general is actually not increasing very much, nowhere near the average of what's happening nationally.
Colin, one reason for that might be the presence of the estate tax in Connecticut, where fewer and fewer states have estate taxation, whereas we still do.
Yep, absolutely.
Yeah.
Absolutely. To talk a little bit about the potential excess number of beds in the market, we talked a little bit about the Connecticut. When we do ratios and comparisons, we always like to look at what's happening on a national basis. It's always more important to see what's happening in your state because not every state's equal in what's happening, as we just demonstrated when we're looking at the population change over the next 5 years. When we look at the number of seniors that are being cared for in a nursing home, what's really interesting is looking at a chart. We've seen the senior population skyrocket really over the last 20 years. The population, the number of seniors continues to go up. But when we look at nursing home census, it continues to go down. And the reason for that is there's a lot of alternatives to nursing home placement now. You have independent living, you have assisted living, memory care assisted living. We're putting more money into Medicaid funding for home and community-based services. There are more alternatives than there used to be for people to be cared for. And so when we're looking at the number of seniors that are being cared for, when we're looking at the number of seniors compared to the number of nursing home beds, we're seeing a big change. In the year 2000, there were about 16 seniors per occupied bed in the state of Connecticut. In 2017, there's about 26 seniors per occupied bed. And then by 2023, we're going to see about 34 seniors per occupied bed. So roughly the more seniors per occupied bed, the lower the utilization. And utilization, again, is declining because there's more options. But another reason it's declining is because, quite frankly, people rather be cared for in another setting if possible.
Very interesting conclusion. When that number goes from 16 to 34, you're telling us that the facts are that the propensity of the population to use the services has gone in half.
It continues to go
Since
down.
2000. That's recent.
Well, even further in 2000, but yeah, when we look at the demographics and the historical number of seniors and then the number of occupied beds, we continue to see the population continue to go up, but the utilization, the number of people in beds, continues to go down. Now, again, every state's different. There are some states where the number of occupied beds actually hasn't changed very much over the last few years. It's certainly down from where it has been. The number of people in nursing home beds has already peaked. We're past that point. There are fewer people. But again, when you look 20 years ago, there weren't as many alternatives, especially affordable alternatives. We weren't putting as much money into Medicaid for home and acute-based services, home care services, home health, hospice, again, independent, could be market rate or affordable, assisted living, memory care, assisted living. There are all types of alternatives. The nursing homes tend to be the most costly option to be cared for. So when you have a less costly option, people are going to tend to choose that. And then government, of course, is driving people to spend more money into other alternative options as well because it's more cost effective for the government.
Can you identify from either your research here or your expertise, essentially when that tipping point started to occur? At what point did the increasing availability of alternative options for people to stay in their home, in their community, less expensive care? Only because I would anticipate that we will face the question about the town doing a study of Nathaniel Witherall 7 years ago, roughly 8 years ago, and that projection was not highlighted, I guess. So at what point do you think things changed?
So again, every state's different. If we were in Arizona or Oregon, for example, that change was actually in the 20th century, where they were putting a lot of money into the managed Medicaid plans at that time. Other states have been a little slower in catching up. But I'd say in the 2000s, there's been certainly a much more effort into putting more Medicaid dollars into home acute-based options. Again, every state's different. If we were in Arizona or Oregon, because of how far ahead they are of other states, you wouldn't have half the occupied beds that you have right now.
But let's say for Connecticut, for our market base, do you have the ability to pinpoint a general range in time?
We can look at where, yeah. I don't have that right in front right here now, but certainly we can look at that, yeah. Absolutely. I think we'll move on to slide 10 for increasing financial challenges. We do operate in a highly regulated business that has seen an expansion of independent living facilities, assisted living, at-home nursing care services. Even if we are able to maintain current capacity, there will be increasing pressure on revenue sources. Reimbursement rates for Medicare and Medicaid are regulated, and almost all of long-term residents at Nathaniel Witherall have Medicaid, which is very typical, and that does offer a lower reimbursement rate than traditional Medicare or private pay. Most short-term rehab patients are either Medicare fee-for-service, Medicare Advantage, or private pay. These are all higher payers than Medicaid. In October 2019, we could talk about a tipping point. This is going to be a big change in the next year. Medicare is changing payment system from the current resource utilization groups, which is often referred to as RUGs, and that's going to focus on physical, occupational, speech therapy, and this is going to be called the Patient-Driven Payment Model, or PDPM. This is going to be focused on time spent on nursing care and and likely reduce reimbursement rates. There are many competing facilities in the market that offer a broad range of services. If you look on slide 11 here, we did look at what some of the alternatives are. There are 7 senior living providers in the market area that provide varying degrees of services. If you look at a few of these, provide independent, assisted, and memory care assisted living. Some of them are standalones, but there are senior alternatives to skilled nursing facilities in your market. I think you're a few slides ahead. We do have that in there, but it's something we're going to talk about. Basically, a short story. It's going to simplify things. Technically, according to Centers for Medicare Medicaid Services, this is a national change. It's going to be budget neutral. Reality is it's not going to treat everybody the same. Some facilities are going to lose in the process. Some are going to gain. Your neighbors across the river here in New York are actually the state that's going to lose the most in the transition. A lot of the coast states are actually going to lose money in the transition, but CMS will adapt, and communities are going to adapt. It's going to create a change in how we look at patients and who we accept. Ultimately, what's happening is CMS regulations are pushing levels of care down to a lower cost of setting. So people that used to be cared for in a long-term acute care hospital, for example, we're now seeing them in a skilled nursing facility. People that have been in skilled nursing facilities, we're now seeing more commonly in home health agencies. That one I don't think is a slide. I think that's just, but.
No, I think you covered it. I think the big opportunity here is that folks saw that the drug payment technology was clearly driven by.
Yeah.
Sorry.
Or is that one for you?
Sure. I think one of the driving factors with the implementation of PDPM is that the current system, the RUGS 4, was flawed to some degree, where providers were incentivized and reimbursed very generously by providing high levels of therapy service, in particular to a particular group of admissions that they would take into the facility. I think a big part of the PDPM implementation is to try and create a rebalancing of reimbursement, if you will. There are a lot of hospital discharges that need services that aren't perhaps strictly therapy in nature. And the benefit of the rebalancing here, and as Colin said, it's going to be a budget neutral for now. And what I mean by that is if they estimate wrong, they'll go back to providers and they'll reset their rates and keep it budget neutral. But the benefit to the provider is going to be that there's going to be a much broader cross-section of admissions for which they will be reimbursed more generously than they have been in the past. So we see it as something that's going to change dramatically the dynamics of the relationship between the skilled nursing facility and the acute care hospital, the acute care providers. Now the system is set so that the skilled nursing facility operators are incentivized to take a more clinically complex patient that may have other disease factors other than just orthopedic needs. Does that make sense what I'm indicating? So it's going to change the dynamics, I think, for the positive. And I think it's going to create unique opportunities for skilled nursing facilities across the country. We're cautioning that skilled nursing facilities that are on the benefit side of the change use caution, because the analysis that was performed that drove that was based on a lot of proxies that were estimates, if you will. And we're not quite sure how that ultimately will play out. So we're urging caution. We're urging all skilled nursing facilities to go through a very deliberate assessment process of learning more about that relationship, as I mentioned before, between the hospital and the skilled nursing facility, understanding what the financial impact is, doing a thorough assessment of how prepared or ill-prepared the skilled nursing facility is to transition into PDPM. There are a number of changes. Obviously, the relationship between therapy services and the patient and the facility will change in a big way. I think there's a lot of changes that will take place in how the facilities are reimbursed for different diagnoses. I think there are going to be huge demands on nursing facilities having to more accurately code the activities of daily living that the residents require. All of these things have to be done with great precision for a skilled nursing facility to not just survive, but to thrive in the new environment. You can benefit, as the numbers might suggest, but if you can't execute in the framework of the new regulations, operators will struggle significantly. So there's a lot of training that's going to be needed, and I think there's going to be a lot of work that'll need to be done on the part of providers as it relates to doing what I described as a clinically complex pivot, and that is working through a process of developing new clinical programs, gaining staff competencies in new areas that make them the most attractive partner for the acute care hospitals, because the hospitals are going to gravitate towards those providers that have the core systems in place that will prevent the things that all hospitals are looking for, and that's readmission rates, excessive lengths of stay, and things of that nature. So I probably said way more than you wanted to hear, but
No,
that's
I don't
kind of
think-
my overview of what PEPM represents.
I think you're addressing what we want to hear in that context, but Kohler made reference that some states are going to be beneficiaries and some other states are not going to be beneficiaries. Why is that?
It's a function of the dynamics of how the care and services have been provided. There's been a lot of states who have leveraged the current RUGS reimbursement, as I mentioned before, by driving extremely huge volumes of high rehab services. And those are the ones that are most impacted by the introduction of PDPM, because that rebalancing, as I mentioned before, is now going to it's going to reward those facilities who, for a large part, have a more diverse array of services that they provide, and they can take care of a much more clinically complex patient versus just throw the maximum amount of minutes at a rehab type of patient.
So would it make sense then for Witherell to reallocate some of the 46 rooms that it has for orthopedic rehab?
What we're recommending, as I said before, is that before we would make a recommendation, we would want to take a thorough look at the PDPM specific impact that it will have on the facility. Take a look at the particular diagnoses of the types of residents and patients they have been treating. I know that through the assessment that we completed, a lot of emphasis is around the rehab services that are provided at Nathaniel Witherell, and they do a great job in that area. And I think we spoke earlier about the short lengths of stay and the high volume of percentage that are going back to home. That's great. But looking to the future, there's going to be a huge need to look outside of that kind of traditional rehab box and figure out ways to kind of expand without losing ground.
Because your initial presentation to us when we were in the bidding process, you indicated there'd be a substantial loss of revenue on the projected conversion.
Yep.
That's the question I was going to ask. What's it all mean for the Witherell? And you answered it in your presentation on page 55, where you said from RUG to PDPM is a 2.6% revenue impairment. Are we multiplying, what are we multiplying that by? Our Medicare business or Medicare and Medicaid business? What am I?
It's all Medicare. So it's taking that population that you have historically served, right, which is a historically high rehab type of patient that you provided services for, and that rebalancing of where some gain, some lose, you're going to have revenue taken away from you as part of that rebalancing that's going to now be made available to take care of more clinically complex patients. Am I making sense of what I say there?
But when I read your table on page 55, minus 2.6% in reimbursement rates, am I multiplying that by the whole $30 million of Witherell's revenues, or the
You're
$8 million that's Medicare, or what?
Yeah, you're taking that number and you're dividing it by the number of Medicare patient days in a year. And that's the amount of reimbursement per day per patient that will
Okay,
transition
on the Medicare
Medicare
segment.
only.
Thank you.
Now, managed care programs are going to start to fall in line behind this as well, but right now, we're just focusing primarily on the Medicare Part A business.
Thank you.
Okay, thank you.
This is a continuation of our prospective revenue and cost pressures. So we have a nice colorful graph on slide 12. And what this indicates, as we've kind of been discussing, this is just a nice picture showing the increase in the Medicare or Medicaid, which is the gray column, versus the decrease in the Medicare percentages from 2015 to current.
The percentages below are total to 100 or total to the occupancy rate at the top?
It should be 100, yeah.
Yeah, total's 100.
Okay,
Yeah, it should be 100.
okay.
It's 85.
Got it.
15 is 100.
Yeah, and basically what that slide just shows is though the occupancy has stayed stable, we're seeing a little bit of a shift from the Medicaid to the Medicare, or Medicare to the Medicaid, which is a lower rate. So that's going to impact your revenue. Slide 13 is kind of a more detailed summary of the recent expenses and net income for the past 3 years. So this is fiscal year 2016 through 2018. And this is all based upon the, the accountant report that we received. So basically what this shows is the breakdown of the total expenses. So we're pretty much looking at $29.5 million for the 3 years. It's been pretty stable in that front. Majority is nursing, and 18 is $13.3 million. And then the next highest would be employee benefits at $5.2 million. So then it shows our earnings before interest, taxes, depreciation, and amortization, which is EBITDA. Fiscal year 16 was a loss of $2.1 million, and that did drop in 18 to a loss of $1.5 million. Depreciation is next, and then that would give us our net loss. 16 was $3.5 million, and 18 $3.1 million. There's some other items, the pension and the post-employment benefit plan adjustment and other non-operating revenue expenses. And then that brings us to our final net loss, $2.4 million in 2017 and $2.1 million in 2018. Some of the opportunities that we have seen through our assessment to help create some greater efficiencies would be to address the labor costs and operational inefficiencies. The wages and benefits, most subject to collective bargaining with unions, comprise of over 70% of the total costs, which were high relative to those of the nearby facilities. Adjusting staffing levels would help create efficiencies. Consider implementing a paid time off policy versus the current non-productive time off. Adjusting new employee retirement benefits that are greater than industry norms, and analyze high shift differentials. Basically, yes, because you have to monitor your staffing levels on a daily basis, and that's part of your operations. But one of the items that we noticed is that obviously they do keep a budget, but no one was aware of it. So in order for you to efficiently have efficient policies and procedures, the departments need to be aware of what the budget is in order to maintain that budget. And then I think further we're going to go into more detail on the business office and accounting processes that we saw that needed some improvements. Actually, I want to jump ahead to slide. It's basically these next three slides, 15, 16, and 17, is all the same data. What I did is I pulled the Medicare cost report data for 8 area communities that were agreed upon by the committee and compared their wage rates for the different positions to that of Nathaniel Witherall's. And then I also looked at a Northeast benchmark data that I had from a publication that we use for benchmarking quite often. So if you go to slide 17, basically what this shows that pretty much every category, the wage rates were higher at Nathaniel Witherall than both our comparison facility average and the Northeast benchmark. The only line that was lower was administrative. But yeah, every other line item on here was higher than the comparison facility average. And again, those were the 8 facilities on the previous 2 slides that we did look at. Greenwich Woods, Carlton, Waveney, Villa at Stamford, Dumont, Glen Island, St. Cabrini, and Andros. So then this column here on slide 17 is the average of those facilities, and then my Northeast benchmark data. Most people record that in with administrative in general. They don't break it out. It happens to be a line item on the cost report, so I was able to get it, but my other publication, it had to be either included in nursing admin or administrative. It could, but usually that rate's pretty low, so if anything, I would think that would drive that rate down, like the 30 in the Northeast benchmark column. But whenever you're comparing, you always have that issue where people are reporting things the same. You don't know. Cost reports are prepared by so many different people. People could be reporting it in different buckets, but at this point in time, that's all the data we have available publicly to use. So we can go on to slide 18. And in our larger report, we did have some other cost per patient day amounts that indicate the same thing. So what I did is I drilled down on the employee benefit costs. I was able to get Connecticut Medicaid cost reports and pull the categories listed here, work comp, FICA, health insurance, and so on, and compute the percentage to overall salaries for the Connecticut facilities that I looked at. I was also able to pull our managed buildings and calculated that same percentage. So the areas that really triggered were health insurance and pension was where Nathaniel Witherall was higher than both of those sources. And I think our next topic is staffing levels, which Kathy will be talking about.
So I'll continue on with what Stephanie started. Can you hear me okay? Okay. So generally higher staffing levels are what we've seen here at Nathaniel Witherall. The CMS staffing star rating is what we compared to, and we did comparisons. So if you look at the first table on this slide, the RN staffing and the total direct care staffing are what CMS looks at to come up with the 5-star staffing rating in combination. And they provide an equal weight to both the RN and the total direct care staffing. Currently, right now, for a 4-star staffing, what they're posting is a 0.50 per patient day for 4-star. For RNs, and for total direct care staffing is a 3.50. For a 5-star, it is required that you have a 0.74, and for total direct care, it is 4.15. It's hours per, it's per patient days, per patient days. Yes, hours per patient day. So how do you figure out the hours? And you'll see it down below, is that per patient day is the PPD. And if you just look at the RN and the table 3, and you will see that we have the 1.0378. And you would take that times your census for that day, the census in the facility, and you would come up with 192 hours, like say if your census was 180. So you'd take the 180. That's telling you that you would have, this is for RNs, you would have 192 hours with, if you have a census of 180, you would have 192 hours of RN staff per 24 hours. That is, would equal 24, if they're 8-hour shifts, it would be 24 staff members. And then we did the average wage. And again, that's not the wage that you maybe hire a nurse at, but we took the average wage from your payroll for RNs, and then that would be the cost per day, the 8,770.
Right. More to the point, as to the RNs, if CMS requires that we carry a 0.74 for a 5-star rating, and we're carrying 1.301, we're carrying more staff for the 5-star rating than a 5-star rating requires for approval by CMS.
Almost double.
Almost double. And so if I were to calculate the differential between the 1.301, I don't know what I'm doing to cause that. I'm just. Let me try again. So if I were to subtract 0.74 from the 1.301, I could calculate the amount of RN cost I'm carrying, which is beyond a cost that would have been required by CMS.
That's correct.
And I could do the same calculation for other total direct care staffing. I'm going to turn this off again.
Yes, you can.
Can you explain the difference between the 1.301 under the CMS staffing and the RN 1.0378?
It's on the next page. It talks about the fact that there's a combination for RNs because the PCCs are also RNs. So if you add those two together, that will give you that RN staffing. Do you see where the second line with it, where it says PCC? So the comparison between the current labor usage and the labor usage with the 4-star and 5-star staffing shows that TNW has a higher staffing level. TNW's total direct care staffing hours are currently at the 4.45 per patient day, or PPD, or about 823 hours per day. Hours needed for 5-star are the 4.15, or 768 hours per day. And for the 4-star, the hours needed are the 3.50 PPD, or 648 hours per day. The RN staffing, in combination with the registered nurse and the patient care managers, show the highest opportunity for adjusting staff and achieving the cost savings. In the 5-year projection that you will see later on in this presentation, I do want to note that we did use a 4-star staffing, and we used a level at 0.62. And for total direct care, we used a 3.79 PPD for total direct care staffing. So when you see those numbers, I want you to be aware of that at a later time. So some recommendations for operational changes. Control of expenses, as Stephanie related to earlier, is that all the expenses were over with the exception of the administration. So to start with, departmental budgets. Provide each of the department managers with the budget for their specific unit at or prior to beginning of your fiscal year. Your fiscal year begins July 1. So we want to make sure it's nice that they can have it by June 1 if your budget's complete, so that they can start working and setting up their expense control logs to be able to have things in place when the fiscal year starts July 1. That way they'll be able to monitor their expenses appropriately and they'll be able to keep on track. Paid benefits, adjust TNW's paid benefits that currently are at 38.3% based on the cost report period of 9/30/17, as compared to the comparisons local communities, which run at a 33.1%. The Northeast benchmark is 20%, and the national average is 17.4. Staff wages are another opportunity. Adjust the wages for new employees in all departments, which are higher than the 8 comparison communities, as well as the Northeast benchmarks. Cost per resident day. Take steps to reduce TNW's cost per resident day by department, which runs higher than all the competitors and also the industrial medium.
Kathy,
Nursing.
can you just for 1 second tell us what factors into that particular metric
For the
per resident day?
the per resident day, it's based on your census. It's based on how you set your budget with the PPD. So it would be the number of census that you have based on your PPD per patient day.
Kathy, sorry, in part I need to fold back to something. So on the points you're just going through now, you're demonstrating to us that our benefits are running somewhat above scale, both for the local area and for the state and for the national makeup. The previous point that you were making when we were talking about the staffing needed for 5-star and 4-star and that we had more staffing, if you know the answer to the question, was there anything about the physical configuration at Nathaniel Witherell that would make it hard to scale back the staffing to just the levels that are required for the 5-star and 4-star? I mean, it seems to me there's a possibility that maybe the floors are configured in such a way that you can't have a staffing at the lower level because it becomes difficult for the RNs and for the other staff to handle the patient load because it moves to a different floor or a different corridor. Why is that happening?
I think there's opportunity to reduce your staff because your Medicare unit is more segregated. The 2 floors are, of course, there's a garden level and then the main level. So there is, an upper level and a lower level. That would be sometimes challenging because your tower then is stacked as 4 levels on the other side for where more your long-term care patients are. And that would be the only thing, but that wouldn't necessarily affect the RNs or the CNAs. It's a little bit harder for staffing. You would have to look at your acuity, but I definitely believe that there's an opportunity to reduce your staffing.
Very useful. I think if we're hearing you, you're saying not only do we pay more per hour than the benchmark in the market, we're staffed more per census than the market. Those 2 factors multiply by each other to make our costs excessive, right?
Yes.
In both domains, we are non-competitive or above benchmark. Let me ask you this question. I'm sorry about the feedback. What am I doing wrong?
Well, I guess I can speak to the fact that I currently am overseeing, it was 34 long-term care facilities. And when you look at the 5-star, it's composed of 4 components, you know, the regulatory, the staffing, and also the quality of care. And along with that, then there's the overall rating. And the quality of care, even though these facilities, one of the reasons they are they're in receivership, but all of those facilities, with the exception of maybe 2, are 5-star for quality of care. It has not, because they are not 5-star for staffing. Okay. Okay. So the last thing is just the nursing staffing is manage the nursing staff to the daily census. I think that's another important piece too, is to know what your census is every day, and once your per patient day PPD is set, make sure you're managing to that and make the adjustments with the staffing. Currently, the nursing department is staffing direct care above the 5-star staffing level, as you're aware. So continuing on is
Kathy?
the business
Kathy?
Can I just ask, do you want to go first, Beth? On that, so with some of my recollection is that with some of the union contracts, there's a time lag before you can shift schedules. So would your recommendation be to start off at a lower level of staffing, 4-star, let's say, staffing, and then supplement with per diems if needed, as opposed to getting caught at staffing at the higher level when your occupancy then on a daily basis is lower without the flexibility to adjust?
I think that if you have the employees and you decide whether you want to run the 4-star or the minimum 5-star, and I would keep it at minimum, I wouldn't run the rate that you're running now currently, and that is all in the larger report that you have access to. I would then start at the base level, and then if your acuity increased, you could always add per diem staff.
Kathy, could I go back to what you were saying about the, and I'm not sure I understood what you said, in terms of the facilities that were 5-star, they went into receivership, and you were, what, managing at 5-star? You were reducing to 4-star? And it didn't have an impact on the quality of service? I'm not sure what your point was.
We are currently managing, and I oversee, there are 34 facilities that are in receivership, so we're managing for the receiver. And they are not 5-star for staffing. Staffing is a struggle in the state that we're in, and so they're not 5-star for staffing. But the quality of care in those buildings, based on our systems and the care that we're provided in our clinical leadership, there are 5-star facilities with the quality of care. Quality measures is one of the areas that is part of the 5-star for your total 5-star. You have your regulatory makes up the 5-star, your staffing makes up the 5-star, and your quality measures make up the 5-star. And then combined with those 3, then you have a total 5-star number.
And when you say that it's currently, that they are actually operating at a 5-star, is that your determination, or is that CMS or
That's
somebody
CMS.
else?
On the 5-star CMS, for quality measures, they are a 5-star for their quality.
Maybe you can identify, so the quality measures are things like activities, the percentage of increase or decrease in activities of daily living, things like that, right? You're
Yes,
talking
and
about, so
your
there's
pressure
a
ulcers,
benchmark
falls.
chart of certain criteria that CMS looks at to evaluate whether or not you reach those quality measures, correct?
That's correct. And some of those are, they look at psychotropic meds, they look at falls, they look at pressure ulcers, they look at your antibiotics, your catheter uses, those type of things.
Kathy, do I understand correctly that you've taken some facilities down from 5-star to 4-star level staff?
Not that I'm aware of with any of our facilities, is it caused a issue with marketing the facility from the staffing level, from the 5-star to the 4-star.
Doesn't affect the compensation rates, the reimbursement rates, either from Medicare or Medicaid. Is that correct?
That's correct. There would be some insurance companies that might affect, but they would not be affected by a 4-star or a 5-star. Some insurance companies will not accept you into their program if you're below a 3-star.
Below a 3-star.
So if
Thank
you're
you.
a 2 or a 1.
Thank you.
And the other thing that's interesting about the 5-star is that for the state, they allow only 10% of all the nursing homes in your state to be 5-star. And in your state, you would only have 20% that are 1-star. So the 4s and the 3s and the 2 get clustered into that 75%. So you could have, or to be equal to another facility, but if you're at that cut point where they already have 10% in the 5-star, you would be a 4-star, even though you're running everything at a 5-star.
Kathy, I'm assuming this is in Connecticut, correct?
Yes.
Okay, do you see that being done in other states as well?
Yes, that's CMS's rule. And I did also include for you in the report with the appendices, there is the whole document for the 5-stars so that you would be able to understand it.
Since your colleagues identified that we receive a very large proportion of our patients from Greenwich Hospital, there is a concern, of course, perhaps, that if we let the level of care or staffing drop to a lower star rating, Greenwich Hospital may be less interested in referring patients to us. Or is that not a reasonable concern?
Well, I would ask, do you know that is a reasonable concern? Have they voiced that concern?
No,
Because
I'm
currently-
not the source of that. I'm really they're couching that as a question.
Well, right now you're a 4-star. I would believe the majority of the hospitals look at the total stars. Sometimes they will look at, and families will look at the breakdown of the star levels. But what I will tell you is that effective in April, the star rating has been frozen for the last, I think it's been about 9 months, maybe a year. It's in the 13th month, a little bit over a year. So it unfreezes in April. So one of the reasons why they did that and they froze the star rating is because they wanted to make it a level playing field for all facilities. And they were concerned that when they started reporting PBJ, and that it's reported now, online, that it's reported directly to, and PBJ is payroll-based journaling. So your staffing hours are actually reported to CMS on a regular basis. So they can actually see the staffing hours, whereas before, they would come in to do a survey, and you would be required to fill out a document that says, here's what your staffing hours are. So people would sometimes up staff, or they would increase their staff right before the surveyors would come in, and the numbers were not legitimate, is what they found out. So CMS has changed their reporting, and now your staffing has to be reported on every day. They do it on a quarterly basis, but you have to report every day your staffing. So it can actually be looked at and tracked by CMS. So they wanted to make sure that when they started, they froze this star rating so that they would give everybody time to then the next survey that comes in when they open it back up, that everybody will be starting with the same, and it will be based on the true reporting of staff. Yeah. For the threshold for them to be 90%, it would be based on what your buildings are running right now. Yes. Well, it would be for the 5-star, yes. It would be any of the facilities right now that would run that level. I don't. I know. Yes. Okay, that's okay. Okay, so we're going to talk about the business office and accounting. So admissions and census. The admissions and the business office staff should work as a team to ensure all necessary information is received and uploaded into the billing software and shared with the billing office staff. Complete an insurance and payer verification form for each potential admission prior to accepting the new resident. Complete an admission agreement for every admission within preferably the first 24 hours, but we understand sometimes it can't be done but within the 48 hours. Resident trust. We identified that the Medicare residents who have chosen to deposit their Social Security checks into the resident trust, or what we call the RTF, ensure that their RTF shows the total Social Security going into the RTF as a deposit, and with the amount of care withdrawn and paid to the facility. Refund all RTF balances for discharges or deceased residents within 30 days or upon death. That is a federal regulation that came out with the MEGA rule, which is the 483.10 F10 Roman numeral 4, and it's called the Notice of Cert Balances. Ensure that no RTF goes negative at any time, because you are dealing with the residents' money, so you don't want to see a negative balance there. Continuing with the business office and accounting, the billing and the collection policy and procedures, Medicare billers to schedule a triple check. Triple check is just a process to make sure that the Medicare or Medicaid claims that you're submitting for payment are accurate. So it's a way to make sure accuracy is happening. So make sure that there's a meeting for the same time each month before submitting the Medicare and Medicaid or managed care claims. We want them to be checked before they're submitted. Review copies of the minimum data set, which is the MDS verification report, to verify that the MDS has been submitted and accepted by CMS prior to submitting any claims. Accounts receivable. Hold monthly accounts receivable meetings with the business office staff, the administrator, and the chief financial officer to accomplish the following. Clearly define credit balances due to the residents and insurance companies and process the refunds within 30 days. If it is determined that they are due to the resident or to the insurance company. Refund credit balances as quickly as possible to comply with that same CMS mega rule, though 30 days within death or discharge. And for accounts payable, just make sure that you're completing the Office of Inspector General, which is the OIG verification, for all vendors prior to employing them. That is just to make sure that there's not something against your vendors' records that would be fraudulent, that you wouldn't want to be associated with them being a vendor for you.
Sorry, can I just, an observation might be that these recommendations are fairly standard business practices that most skilled nursing facilities would typically be following, right? Is there anything in these operational, business accounting recommendations that one might find unusual, or it's expected practice?
No, those are very definitely expected practices that should be in place in systems, but they were not at the time that we did our assessment. Right, so I'm going to turn it back over to Stephanie, and we're going to talk about our strategic options. Okay, thank you.
HTG was asked to review 3 strategic options for Nathaniel withdrawal. Those 3 were continue as a town-owned facility, basically as is, and work on some greater efficiencies in the operations. A sale or lease to a 501c3 not-for-profit corporation, or a sale or lease to a for-profit corporation. So we did take into account the key attributes in the table on slide 24. Some things that are, I think, important to the facility currently, and just how that would play a role going forward. The first key attribute is whether or not the facility going forward would be a part of the fabric of the town. Obviously, as is, that would certainly continue. Under a 501c3, that would also be likely to occur. Maybe not as likely under a for-profit scenario. As we've mentioned several times about the high employee cost structure, as is would not likely change going forward. Selling or leasing to a 501c3, both other scenarios could give some flexibility or a potential to reduce those costs.
Reach the conclusion on the second category, on the sale to lease, sale or lease to a 501c3. On what basis do you say there's a potential to reduce? Do you know of other instances where that has worked that way? Or do you have some basis for that?
Yes, we're basically assuming that there would be some, obviously, negotiations with the union would have to occur.
Respectfully, you're saying more than that. You're saying that negotiations would occur, and that there's a potential for those negotiations to produce a successful result.
Correct.
On what, from what do you conclude that? I personally have a misgiving as to whether or not we would achieve a successful negotiation with the unions on a sale to a 501c3 or a lease to a 501c3, particularly if it were a 501c3 that the town controls.
We've had experience in the past. We've taken over many county-owned facilities and have changed structures going forward. That's kind of been a niche that HGG has worked with, and we did work on another facility that was, I guess, government-owned, and started a new structure under another corporation. So we have seen it occur. Can I guarantee it? No.
No, I'm not looking for guarantees. I'm just looking for your prior experience, really. In those instances, these were not private corporations, private entities to which the facility was sold or leased. These were not-for-profit charitable institutions that the municipality or county or whatever state owned or controlled?
Correct.
Thank
Yes.
you.
Yeah, we have a nonprofit entity that we manage several facilities for, and some of those facilities were previous county-owned facilities. And we were able to see some savings.
The
yes.
union agreements in that context?
I believe so, yes.
Thank you.
The next key attribute is the ability to have tax-deductible contributions. As a current government facility, that is not possible right now. that would be possible under a 501c3, but not a for-profit operator. Focus on quality of service is more likely for an as-is scenario and a nonprofit scenario. Probably not as likely for for-profit. Of course, they would want to have quality, but I think the reputation is in the industry that you have more quality from a nonprofit. Potential for economies of scale doesn't exist currently, and that could occur under a new management agreement or a new operator scenario. Currently, the facility is government restricted, and that only way that would go away would be to go under another ownership structure. And the last one is market responsiveness. Excuse me. We believe that would be more enticing under a non-for-profit scenario.
For the for-profit owner, I would also think they'd be more flexible.
Yes, it definitely could be.
As opposed to less.
Yeah, I guess I could see, I guess compared to a nonprofit, it probably wouldn't be as responsive, but probably more responsive than now, yes. And then slide 25 is a summary of all the key assumptions that I used in my financial models. We did also include a couple of different staffing options for the as-is scenario. I assumed a reduced census in all scenarios based upon the market data we presented earlier. So we adjusted it to a total census of 162, which is an occupancy of 80%. Average daily census. Yep. And then the current fringe benefit percentage of salaries as of the June 30 financials was 34%. For the other two scenarios, I did drop that to 27.8, which was the comparison facility average in the area. Wage increases was indicated that those would be around 2.25%. I used 2 in the other scenarios just because it should kind of follow your Medicare and Medicaid increases typically. Nursing staffing level, the as-is scenario is at the current staffing levels. We did a couple different scenarios at a 5-star. My 4-star scenario is actually a little bit above the 4-star just because we did kind of a staffing grid based upon the units of the facility and what would make most sense. So it is a little bit above the 4-star minimum, but would still be considered 4-star. And then that's the same I used for the for-profit and non-for-profit scenarios. Currently, the facility is getting over $200,000 in contribution and grant income, and my assumption was that in a 501c3 that could potentially increase due to the tax deductible potential. And then I pretty much took that out for a for-profit. We've kind of seen in our experience that if they think you're ran by a for-profit, people aren't as willing to donate. So I took that out. The property taxes, obviously we would need to add those in on a for-profit scenario, and I received an estimate of $125,000, so that was included. Currently in the state of Connecticut, nursing facilities pay what's called a bed tax, and that's based upon the non-Medicare patient days. The current amount, based on it being government-owned, is $16.13 per non-Medicare patient day. Under a new ownership structure, that would go up to $21.02 per non-Medicare day. And that's just a state of Connecticut thing. Currently, the facility gets about $1 million allocation from the town of Greenwich for services that it receives. So what I assumed in the other scenarios was that there would be some sort of management fee. Obviously, it could be an operator that doesn't charge a management fee, but they would need to go out and get services that they are currently receiving from the town. So I definitely needed to have some dollars in there to account for that.
Looking at your last category there, so is your suggestion there that if we hired outside management, I guess your firm does that kind of business, that the fee would be in that order of magnitude that you're reflecting at the bottom?
Yes, the industry is around 5 to 6% of revenue.
Thank you.
I believe I used 5, and I'd have to look, but it's somewhere in that range.
Thank you.
So those were the assumptions. Slide 26 is a summary of basically what the numbers were in year 5 for the different scenarios. As is, as you can see, a loss of $3.3 million. After, capital costs, a loss of 4.9, and then with the non-operating, a loss of $4.6 million. That would drop to 3.9, going to the 5-star minimum staffing, and 2.8 million at the 4-star, or it was a little bit above the 4-star. Sell to lease to the nonprofit. I have it basically at a break even. I did pull all of the state averages for for-profit and nonprofit, and it's kind of in the range of where they are. Nonprofit would be break even, and for-profit would be a slight margin after the property taxes are considered. I come out to a net income of around 261 for the for-profit scenario, or a margin of 1%. And again, the baseline were the June 30th financial statements that were provided to us as a starting point. Yes, correct.
Can you just talk a little bit more about your experience with the management fee for not-for-profits? Is that, when you say 5 to 6% of revenue, is that based on municipalities or some governmental entity essentially doing the same kind of thing as you're recommending here, taking a municipally owned skilled nursing and contracting with a not-for-profit provider to provide management services, or is it based on something else?
Management fees are pretty standard no matter what kind of operator they are. I've done tons of benchmarking on that, and it always ends up 5 to 6% of revenue. I've seen a couple higher than that, but that's usually if they provide extra services. It could get higher, if they do all the billing, or if they do X, Y, and Z. It all depends on what services you're getting, but I wanted to start off with what's typical in the industry. And it really doesn't matter whether it's nonprofit or for-profit. It's a matter of what services the management company would be providing. So slide 27 is just a summary of the recommendations. We recommend further examination of the scenario to sell or lease to a 501c3, either existing non-for-profit or establishing a separate entity while continuing to make operational improvements. The 501c3 and the for-profit, we're that far off financially, but the for-profit is more sustainable for the Nathaniel Witherall. I did not include any vacation payouts just because I didn't have the data as far as if there's a new ownership structure, those dollars would need to be factored into any analysis that's done. And then other assumption is that the town would retain the bond obligations for project renew of the facility. We definitely have done that many times. Darren, can you jump in?
Art, may I have the privilege, I'm very interested in discussing Alan Brown's comments, but I had a couple of questions for Stephanie before you changed gears to that. May I still ask questions?
Sure, okay.
Can I take you back to page 26, sheet 26 for a moment?
Sure.
I had a couple of concerns there. I mean, so on your scenarios, you have zero of an interest cost as a 501c3 and as a for-profit manager, whereas you have $560,000 worth of interest expense. The interest expense on the bonds continues. It merely gets left behind to be paid by the town. So for the town to weigh these other two choices, those cost figures shouldn't be zero if we're looking at from a standpoint of what's the cost to the town to experience these scenarios. Am I right?
I think my assumption would be this 1.2 million would go to the town. So the new operator would lease from the town.
So you
There'd
haven't,
be some kind of lease.
but you're
payment.
showing the income factor on the lease payments.
The person that owns the building would carry the depreciation. If there's another operator that actually owns the building, they can't depreciate the building. I mean, the Nathaniel Witherall can't depreciate a building if they're paying someone else rent. I'm assuming the person that is receiving the rent is carrying the building on their books.
Separate question. Implicit in your 501c3 and your for-profit manager is an assumption that they would be able to instill certain operating economies, including a renegotiation of the union agreements. I don't know how to handle this, Mike. These union agreements. If I went back to the first scenario, the as-is scenario, but hired a skilled outside manager, is there, you put no credence in the possibility that some of the economies that could be created as a 501c3 or for-profit couldn't be instilled in its present operating format if I had skilled management assisting me?
Well, that's kind of why I included option B and C, because there's obviously staffing opportunities you could have there. Certainly, we could run another scenario with that particular instance. I was just given these three scenarios to kind of run with, and I'm happy to run some more, and you guys have all the Excel templates, and we can run
Okay.
definitely some more scenarios.
All right. Well, so maybe that's something we'll come back to you about. Thank you. That's all I have, Art. Thank you.
Good, thanks. Just to start off, I want to corroborate some of the comments about the lease management idea that was presented. I know you all know that I previously worked up at what was then the Smith House in Stamford, which was owned at that time by the city of Stamford. The city, though, did not operate it, even when I was there, like the town of Greenwich does. They had a management company, and the management company provided the services that Stephanie referenced. Stephanie, did I get that right? Okay. And the way they handled it was to hire the executive staff away from the city. So the administrator, the director of nursing, and the director of admissions were employees of the management company. Those salaries and benefit costs were passed back through to the city, and then they overlaid a management fee on top of that. So that would not be any different than what Stephanie described if the town decided to engage a management company, whether it be Health Dimensions Group or anybody else. The other thing I sort of as a general comment was that I thought there were a lot of very helpful suggestions in the report. And I commented on some of the things that they said simply to elaborate on on what the comments were. So for instance, for those of you who are less familiar with the operations of a nursing home than we are, when somebody says that our readmission rate is lower than the industry norm, I wanted to make sure you understood that that was a good thing. Or that our discharge rate to the community was higher than the industry norm, that too is a good thing. Not the same as our labor rate is higher than the industry norm. So, those are sort of underlaid some of the comments that that I made in my epistle. Some other general comments. Even as I jump through some of the reports that you reviewed today, the numbers are different depending on which exhibit you look at. And one of the things that's sort of stuck in my head is that none of the numbers related to our hourly wage that are reported anywhere in this report are completely consistent with what our ADP report indicates is the hourly wage. And the one that sticks in my head as an example is what we pay our LPNs. There are only 9 of them, and they all receive the exact same hourly wage at $34.93 an hour. That wage is nowhere in this report. And again, in one of the charts that I referenced that was in the report, none of the information that was in the chart corresponded to the information that I got off of our ADP runs. So I was a little concerned about that. One of them, the director of nursing position, actually showed off of ADP as higher than the HDG hourly wage, and almost all the rest of them on ADP were lower than their reports. So I was a little concerned about that. I also had some concerns about some of the concluding comments. For instance, in the rear portion of the report, there are a couple of these charts where they talk about shift differentials, and they say that they are not applicable in best practice. So what I did, just to make sure my impression was accurate, and my impression, by the way, is there's no such thing as a healthcare provider in this area that does not pay shift differentials. But what I did is I went to their charts earlier in the book, specifically the charts on page 2930, and then the chart on page 47, which summarizes the comparable facilities. And I made calls to either the administrator, the director of nursing, the director of finance, or the HR director to ask whether or not they were conducting best practice. On the comparable facilities on table 38, I spoke directly with 7 of the 11. All 7 paid shift differentials. And on page 30 and 29, I spoke with all of them, and all of them paid shift differentials. So again, what concerned me a little bit was the generic statement in the back that shift differential payments are not best practice. In this area, they are best practice. That's how you make sure that you can staff your evening and night shifts, and sometimes weekend shifts as well. So those were generic comments relative to the response that I provided. I simply went through the report and things that struck me either as a positive or a negative about what the comments were in the HDG report. I made a corresponding comment, again, either to elaborate or to discuss whether I thought the information was correct or not. The other interesting thing is...
Alan, before you go off shift, can I just ask a question about that? Mm-hmm. So the shift differentials that you're referring to, I don't know whether this is to you or to HDG. The shift differentials would be included in the average hourly wage rate that's calculated, correct? So that the comparison of the wage rates if the market facilities have shift differentials, their wage rates would include the shift differentials, as would Nathaniel Witherall's. Is that correct? Because you're getting the information you said from CMS, right? Is that, or wherever?
They got their information from us.
No, I thought Stephanie reported that she got the wage information after the cost reporting.
Right, right.
So just to restate, just to make sure I'm understanding, you got the comparable facility wage rates from their filed cost reports with the state, right? And so their average hourly rate would include any shift differentials that they also charged, so that so other than the statement, when we're looking at the comparable wage rates, shift differentials are worked into that.
But it's a misrepresentation to say that shift differential is a best practice. This. No.
Alan,
So-
can I ask you, are you referring to the labor tables that are? Can you hear me? Okay, sorry. Are you referring to the labor table in the report?
Well, let's see.
Not the wages by the comparables, but the table that you flip back to the back. Is that part of the assessment based on
No, I was
your?
referring to, on page 59 of the report, there's a table 49. And again, in my comments, I just went through and looked for some representative positions. So, hang on, let me just get to the right page.
I was where you said that it was not applicable.
Well, so on page 59, there's a big chart with wage rate comparisons. So I just took, again, some of the representative positions. Did you see my comments? Yeah, okay. So if you get to the second page of my comments, I just took out those 7 or 8 positions, looked up what the hourly wage was for each of the people in those positions, and then compared them to what you reported as the hourly wage. And I did not get a dollar-to-dollar similarity.
That concerns me as well. So how I got them was taking that Excel spreadsheet we were provided and took the productive, this is just the base rate in this comparison. All the other tables were total rate. This particular table, because this is from a pay factor software that only reports base rates. So I took your total productive wages for that position divided by the total hours. I can send you but yeah, we definitely should reconcile that. I agree that that's concerning that they're different, but I used kind of a different source.
Yeah, I would not argue with the generalization that the hourly wages at Witherall are highly competitive in this area. In other words, they're above average. Whether or not the conclusion that they're at the 75th percentile is accurate or not, I can't comment. I haven't done an extensive review like you did. But let's say that that is accurate. Then the question that comes next is, if the town decides to make a change in the strategic way the facility is managed, how do you address that when you have unions that have to be involved in the negotiations? And actually, an interesting example that you might want to research, about 12, maybe 14 years ago, I worked for a brief time at a facility that was then owned by Stanford Hospital. was called the William and Sally Tambit Center. The hospital indicated that nursing homes weren't part of their core business, but what they really meant is they were losing too much money to sustain the facility, and they decided to sell it. They sold it, I believe it was a for-profit, I'm not sure, to a company out of Georgia called Altacare. And Altacare made the same assumptions that you indicated in your report. They would renegotiate benefits, they would change to from a paid time off to a fixed number of days model. They would reduce their benefit costs, and the short story is that they came in, their negotiations with the unions failed. Jesse Jackson came to town, marched in the streets with the labor unions, and again, the short story was 3 years later, Altacare declared bankruptcy in Connecticut and closed the building. It's not that easy to come to the Northeast and get concessions from unions. It might be in the Midwest. It certainly is in the South. I worked for a number of years, many years ago, for Humana, and Humana got what it wanted. I worked for Humana after they purchased the hospital in Philadelphia, and they came up thinking that they were going to do the same things that they did in the Southeast and the Southwest, and they were unsuccessful. And I'm a doubting Thomas as to whether any management company or any for-profit can come into Connecticut and get concessions out of these unions. They are among the most militant unions in the country. And from my perspective, I wish whoever comes in and negotiates those good luck. I don't think they'll be successful. Yeah. Well, the Smith House, I mean, I had already left the Smith House when it was sold. From what I understand, when I was there, it was 128 beds. It's now 90 beds. I do know a little bit about what's going on because we have probably 24 staff who work at our place and also have jobs at the Smith House. Many of them had their hours cut back and left. They had retirement benefits. They took their retirement. And as far as I can tell, they're doing okay. I don't know what their finances are, but I think they're doing fine. I don't think that's the way it works. You have to decertify the union. Yeah.
Smith House,
It's Sorry, Jeff.
it was sold or leased to a for-profit private operator. So it's that particular option, and the experience at Smith House may or may not apply to a setting in which you create an entity, a 501c3, which the town controls effectively or maybe literally, and then expect that the union will be accepting of a renegotiation in that. But
It's regionally, there are lots of differences. I only worked for Humana for a couple of years, and when they offered me a position in the Southeast, I told them that I was a city boy and I'd be willing to go as long as they put me somewhere in an urban area. And the first job they offered me was in East Ridge, Tennessee. So I said, well, where is that exactly? And they said, well, you should call because the administrator always earns 100% of his bonus. And I said, yeah, but where is it? They said, well, it's about 100 miles from Chattanooga. And of course, a Philadelphia boy like me, I didn't even think Chattanooga was a city, So anyway, they used to send their labor relations people in to try and negotiate with 1199, which was the dominant union in Philadelphia, also in New York City, and they didn't have much luck either. And they ultimately decided to sell the hospital.
so let me try, if I may, a different scenario. Sometimes when you bring a consultant or an outside manager in, it creates an atmosphere that makes changes a little more able to implement. They don't stay forever, but they come in as sometimes maybe even the hatchet men to make certain changes, implement the changes. The ill will is towards them, and then they depart. So you have a setting here in which I have a facility which, in broad strokes, has two problems. One, it may have higher staff than is necessary for me to maintain the level of remuneration in both Medicare and Medicaid. Secondly, I have staff that are being salaried somewhat higher. If I make changes to a 501c3 or lease or sell to a private operator, sometimes those changes can be destructive, do things that you can't then recross the bridge and go back. But I see a possibility here, I'd be curious about your reaction to it, of remaining as a municipally run facility. Bring on an outside manager who imposes substantial changes in the staffing levels, to bring them down to closer to the levels only those required for 5-star and 4-star ratings. So far as the wages and benefits are concerned, as long as we maintain a municipally run facility, it isn't a pure negotiation with the unions. At the end of the day, if there's a failure to reach agreement, it goes to an arbitration. It goes to an arbitration in a setting in which all the benchmarks, there are no other municipally owned nursing homes in the state of Connecticut, all of the benchmarks are private industry. I'm not thinking that wages and benefits would change suddenly overnight. I'm thinking that over a span of 2 or 3 union agreements, it would begin to scale back to become more closely emulating wage scale and benefit scale in the private sector. And that between slowly squeezing back on wages and benefits and not so slowly squeezing back on our staffing levels, with the aid of some outside intervention, we could get the expense gap that we're experiencing at Nathaniel Witherell under control. I'm curious about your reaction to a scenario like that.
I think it could work, actually. And I also think it might be possible, going back to Kathy's presentation on staffing levels. And one of the things that surprised me about her conclusions is that we would more than double the 5-star rate. We have not changed staffing levels appreciably in the 10 years that I've been on board, and I can tell you that 3 years ago, with the same staffing level we have now, we dropped to 4 stars. We didn't change a thing. We just dropped to 4 stars. And if you looked at the analysis that CMS provided, we dropped below what they called their cut point. The following year, again, without changing anything, we got back up to 5 stars in staffing. The other point that I think is important for you to understand is that in the categories that CMS uses to come up with their 5-star rating, whether it be 1, 2, 3, 4, or 5. The most important of those categories is what Kathy referred to as the regulation. It's the state annual survey, and that counts for half the total score. So if you do poorly on your state survey, the other 2 categories, which are the quality measures and the staffing, sort of they're countermeasures to the bad score that you can get as part of the state survey. And as you know right now, we've had a 5-star rating until the last year, after which they froze us at the 4 stars. We dropped down a star. And the reason we dropped down a star is that we had what they call a G-tag. A G-tag is a high severity deficiency that resulted in that case as a result of somebody who fell in the bathroom and fractured her hip. That tag dropped us down to 2 stars, and there were other issues as well, but they were all sort of the generic minor severity scores that you get. And it dropped us down from 3 stars in the state survey down to 2 stars. And I think if we had not been a 5-star facility, and I commented in my comments to the report, that the 5 stars in staffing helped to keep us from dropping any further. And that's true the same way of the quality measures that Kathy referred to. And we've been 5 stars in quality measures since the CMS 5-star program was first initiated. Traditionally, though, we were 3 stars in state survey, 4 stars in staffing, and 5 stars in quality measures. It's only in the last couple of years that we've elevated to 5 stars in staffing, and again, we didn't do that because we changed staffing. The other thing that sort of strikes me as I was listening to her comments is I know how we staff. We staff on a ratio of RNs, LPNs, or aides to residents. So for our typical nursing units, we have 40 beds. During the day on a 40-bed nursing unit, we have 2 nurses on the day shift. Then in the evenings, we have 1 nurse, and on the night shift, we have 1 nurse. On the days, we have 6 CNAs in the day shift, 4 CNAs on the evening shift, and 2 CNAs on the night shift. So to think of us cutting that in half doesn't compute for me. I don't know how we would cut it in half. We could probably cut the number of staff on duty who are at the CNA level, but it's unlikely that cutting 1 nurse out of a unit would do us any good. And there again, would you want your family member on a nursing unit with no nurse, only CNAs? So, the 1 nurse evening, 1 nurse night probably doesn't give us much opportunity to make cuts. The 4 nurses, or the 4 CNAs evening, and the 6 CNAs during the day probably has some flex. But we also staff with the expectation that some of those are going to call out sick. And if the census is below the full occupancy, we don't replace them. And that's why the more than double doesn't compute for me. Again,
It felt wrong sitting from the back row to say thank you again for your time. We really appreciate it. I think we've had a very robust dialogue about what options and opportunities are available for things. So. Yep. Yep. Sure. Yep. Sure. Sure. Thank you. Sounds good. Thank you, all the members. Appreciate it. Thank you.
I move that we accept the report.
Please rise for the Pledge of Allegiance. pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. So I'm going to start off with just a few comments. For those of you who don't know me, my name is Jill Oberlander. My microphone is on, but maybe it's not working. And if I lean, oh, now it is. All right. Here I am, way down by the mic. For those of you who don't know me, my name's Jill Oberlander. I'm the chair of the Board of Estimate and Taxation. I would like to thank the members of the BET as well as the members of the Board of Nathaniel, Board of Nathaniel Witherall for making time during what is a very, very busy season to receive the report from Health Dimensions Group. I'm going to ask Larry Simon to introduce the members of the Board of Nathaniel Witherall. We have name tags up here for the BET. And then I'm going to ask Art Norton, who is the chair of the BET Special Committee on Nathaniel Witherall, to introduce Health Dimensions Group. I would like to clarify that this is a meeting of the BET with the cooperation of the Nathaniel Witherall Board, but it is not it's a public meeting, but not a public hearing. So we'll be receiving the report from HDG. Members of both boards will be able to ask questions, but it's not going to be a public hearing per se. That said, I'm gratified that so many members of the public came out to hear this report. Members of the BET as well as HDG worked very hard over the last 6 to 8 months on the materials and with the cooperation of Nathaniel Witherall. So thank you for the dedication of the BET members and the consideration and support of Nathaniel Witherall as well. Larry. Or Mr. Simon.
Thank you. I'd like to introduce, is this on? It's outside my job scope. It's on. It's on. I'd like to introduce the 5 other members of the Nathaniel Witherall Board. In total, we have 9 members on the board. As currently, we have 1 vacancy, and 6 of us are here tonight. Starting from my right, your left, and the person can stand, Joan Merrill, Nim Patel, Elizabeth Sidorides, Richard Kaplan, Suzanne Hogan. The people that are not here but on the board are Louise Buchel and Nisha Hurst, and we thank you for including us in the discussion. In addition, we have our executive director here, Alan Brown, our Director of Nursing. It's wrong. Ed. Say it again. Ed. Forget this. Ed Amani. We have also the Chairman of the Friends of Nathaniel Witherall, David Ormsby, and other members of the Friends of Nathaniel Witherall Board. I thank you.
Thank you, Mr. Simon. I'm going to introduce Mr. Norton, who served on the BET for many, many years and was chair of the special committee when it was initiated. He kindly agreed to stay on to continue the work of the special committee and has been leading this effort. Mr. Norton.
Thank you, Jill. I have chaired the committee since it was created in March 2017, so it was approximately 2 years ago last week that this committee was created. The committee, for the fiscal year ending, or the year ending on December 31, 2017, the committee completed a extensive report of over 100 pages, and in addition to that, over my signature, we sent out a synopsis of that report in which we identified options going forward for Nathaniel Witherall as well as some Recommendations.
Thank you very much for the kind introduction. Can everyone hear me okay? All right. I'm not going to let that thing go 2 inches away from my my mouth here while we're spending some time this evening. Thank you for the kind introduction again. I appreciate it. And thank you to all the members of the various boards represented here today. My name's Darren Hull. I'm with a company called Health Dimensions Group out of Minneapolis, Minnesota, as was mentioned previously. And I'm joined by three of my colleagues that I'd like to introduce now at this time. Kathy Carr, who's our Vice President of Consulting Services. Kathy served as the project manager on the operational and financial assessment that we completed on the Nathaniel Witherell. So she had a pivotal role in overseeing the team that pulled all the information together that we'll be reviewing and discussing throughout the evening. I'm also joined by Colin Higgins. Colin is our Director of Analytics and Research. Colin oversees and leads all aspects of the report as it relates to looking at market demand and future demand analysis work, trying to give some vision and some insight as to where we see the need for skilled nursing services going into the future, which is critically important without saying. I also have with me Stephanie Cyrus. She's the lucky one that lives in Florida, just outside of Tampa. Stephanie Cyrus serves as our Director of Financial Planning and Analysis. And again, thank you all for your time. I'll be very brief in my comments here. Do we have a screen that we're going to be showing? If we could pause for maybe 1 second, and maybe I can, you can work on that. I'll do a preamble here real quick, get everybody up to speed, and hopefully by the time my comments are over, we'll be good to go with the screen. We may need a little bit of AV support with the So we have full command of everything on that laptop, but I'm not sure about the connection to the projector. We'll pause for 1 second. My apologies for the delay. Nope, no worries. Yes, thank you. Yeah, there's a his precious cargo there. There we go. All right, well, let's get started. A special warm thanks to the group in the gallery here as well. I feel like I'm in the surround here, and I think that's a reality. By way of preamble, just wanted to give a quick update to those who did not have an opportunity to sit through the session earlier this afternoon. In 2018, Health Dimensions Group was awarded a contract to provide a financial and operational assessment of the Nathaniel Witherell, really with several goals, one of which was to ID performance trends and opportunities for operational improvement, as well as complete a thorough analysis of what might be some best strategic options for the skilled nursing facility moving forward. Today's presentation that will be given by a number of my colleagues here this evening is a compilation or summary, if you will, of the previously submitted full report, which was submitted on February 26 in concert with a full presentation of the same material on the same date. Again, I wanted to reiterate how grateful we are for all of the Nathaniel Witherell staff that participated in the operational assessment and the financial analysis that we completed, all the volunteers, all the board members, committee members that gave generously of their time in responding to our needs as we completed our very important work. For those of you that are not familiar with our organization, Health Dimensions Group is a full-service healthcare consulting and management company. Over the last 18, 19 years, we've had the privilege of supporting hundreds of clients throughout the United States and all 50 states, actually. And those clients range from everything from large health and hospital systems to small individual one-off skilled nursing facilities and a variety of other healthcare operations in the post-acute space. Everything we do is focused on senior care, and that's the only space that we operate in. In addition to a full-service consulting organization, we are also a healthcare management company as well. And what makes us unique is the fact that not only do we provide consulting support to organizations throughout the U.S., we actually are owners, operators, and managers ourselves. So the lessons that we have learned over the years has only helped us refine how we go about our work of serving our clients. As was mentioned earlier, we've been engaged on 3 previous occasions to support the efforts and the initiatives at Nathaniel Witherell, once in 2003 and 4, doing some financial analysis work, and then 2 additional projects in 2010, 2011, respectively, helping to build out a long-range plan for review by various parties. I've introduced my team. I'm very, again, grateful to be here this evening. Different ones of us will be taking the podium throughout the evening, and we're very open to any questions that you may have as we walk through the materials. So with that said, I'll introduce Stephanie Cyrus to begin. Thank you.
Good evening, everyone. I have a few sections tonight because I did a lot of the financial work on the project. I have a couple of slides here, and then I'll be gone for a bit. But the first couple of things I wanted to go over was basically the makeup of the residents at the Nathaniel Witherell. They have 2 business segments. They have long-term nursing care as well as short-term rehabilitation. Oh, yes, we're on slide 4. My apologies. Long-term care, rehabilitation, and short-term care. 156 beds are long-term and 46 short-term for a total of 202 total licensed beds at the facility. They have 3 primary pay classes: Medicare, Medicaid, and private pay. Medicare is 27 of the occupied beds, and Medicaid makes up 104, primarily in the long-term segment. And there are some private and other, which would be managed care and commercial insurance, that make up the additional 48 occupied beds here. To know where they came from, slightly less than half of the residents come from an address with a Greenwich zip code.
You want to wait until they're done, or can we ask questions as the slides progress?
Yes, ask questions as the slides progress.
Yes, so actually, this was July through December of 18, which is technically the start of fiscal year 19. Yes, correct.
Stephanie, can you, if they are not using a microphone, if you could please repeat the question so,
Okay.
into the microphone so other people can hear it?
Sure.
Thank
The
you.
question was what time period this was from, and this was taken from July through December of 18, which is the beginning of fiscal year 19, since they are a June 30th year end. The next slide 5 is just a summary of the revenue by the different payer classes. We are showing 3 years of data from fiscal year 2016 through 2018. Medicare is the best paying source, and that makes up currently of fiscal year 18 $6.9 million of the total revenue. That did decrease about $1 million from 2016. Medicaid is the highest volume of patients, consisting of $10.3 million of revenue. And then private pay at $8.9 million and other at $1.9 million, which is managed care, commercial, and our Medicare Part B revenue. So overall, $28 million in care-related revenue at the Nathaniel Witherall currently for fiscal year 18. Our next segment is talking about the market area, which will be Colin.
Fiscal year 18 is over.
Correct. Correct. This should be net revenue. Yes. Yes, that is correct. There were some renovations going on, so at certain points the beds were out of service. I didn't have the exact bed dates of that, so I kind of have to go by licensed beds. But yes, there was some renovations going on, correct.
All right, hello, I'm Colin Higgins. I'm the Director of Analytics and Research with Health Dimensions. And for the next 6 slides, we're going to get into the market analysis and talk about what's happening in your market. If we're hopefully looking at slide 6 here, we have identified what your market area is. We're going to get a little bit more details on the next slide on that. Whenever we look at a market area, we want to look at many different factors of what's happening, including population, who are the other players in the market, so we can get an idea of who we're playing up against, what demographics are looking like. We need to know what's happening now so we know what's happening in the future. Right now, there are 7 skilled nursing facilities located in what we identified as your market area. The overall star rating goes up to 5 stars maximum. In your market is 3.7 for an overall star rating, which is very good. You have 940 skilled nursing beds and an average occupancy of 86%. The Medicaid mix, as Stephanie already talked about, is about 2/3 of your census. This is pretty typical for an average market. Most markets run somewhere in the 60 to 65% for Medicaid. Occupancy of 86%, something that really jumped out pretty quick to me. That does indicate with an average occupancy of 86%, we typically look at somewhere between 90-92% for a market that is right-sized. Right now, with an occupancy of 86% for your average, I want to clarify and indicate that an average occupancy is throughout the entire year. Depending on the time of year, that's going to be different. In winter, occupancy is probably going to be a little bit higher. It might be 92%. Summer, it might be a little bit lower. But with 86%, that does indicate an average of about 14% of beds being vacant. We're always going to have some vacant beds because we're going to have people coming in, people being discharged. We have both the long-term care and short-term rehab. So there's always going to be some vacancies. But that does indicate, on average, that there is somewhat of an excess number of beds in the market. Yes, ma'am.
Sorry, I thought you were done. Can I ask you why King Street Rehab, which also has skilled nursing, wasn't included in this?
So we identified all the skilled nursing facilities that are located within your market area. And it's actually an excellent segue to the next slide. In Worcester? Portchester. So, yep, so that's not part of your identified market area. On the next slide here, we're going to identify what is your market area and how we indicated that. So the question is, do we include, so they include the beds available to the public. So 940 is the maximum number of beds. If they're licensed as a skilled nursing facility bed, then they're included. If they're not a skilled nursing bed, then they're not included in the analysis. So if they're assisted living, memory care, independent living, those are not Medicare certified beds. They can't take a short-term rehab. All likelihood they're not Medicaid certified, so it's a different payer category, completely different licensure and target audience that they'd be caring for. Does that answer your question? Okay. Okay. Correct. That's correct. They're not open to the public, but they're, okay, so the question is, for a continuing care retirement community, which is more commonly known as a CCRC, they have, in a CCRC, you have access to independent living, assisted memory care, and then a skilled nursing facility. In a typical CCRC, you have an entrance fee or a purchase price model, so it's only available to individuals that live within that facility. Oftentimes, that's the case, well, really exclusively, it's the case for long-term care facility patients, that they're not going to admit people from the outside. Many CCRCs actually will admit people who are Medicare. So they will take people that are coming in to do their Medicare rehab from the hospital because they're not a permanent placement and will transition back to their home. They will not take someone who is going to transition into long-term care from there, but they would take them if they're going to transition back to the community after their stay. The other reason that we include them is because your market area includes all individuals that live within your market area. And so when we're calculating the overall bed demand, regardless of where they're living, CCRC, in their own home, in another skilled nursing facility, the demand reflects the entire population living within that market area. So it is available to people that are living in this market. Does that answer your question? Okay. On slide 7, we're going to talk about the market area. And how we determine a market area is we look at the zip code of origin. With the zip code of origin, we identified everyone that's currently living within TNW, and we wanted to look at what zip code did they live in prior to moving on to the nursing home. And a typical market area is identified where between 70 and 80% of your clientele originates from. That's where your marketing dollars are going to be most effectively spent. A typical market area, again, 70 to 80% of where your residents originate from. In a typical market, that's less than 10 miles. People tend to want to stay within their own community. That's where their friends, their neighbors, their family tend to be. It's where the services that they're familiar with, oftentimes their doctor, medical services, are in their market. So people tend to not to want to move very far, especially to go past other communities that they're familiar with to go elsewhere. The 20 to 30% that are originating from outside of your market area, the exception, they tend to be people that live near but not in the market area, or they move to be near their adult children. They might originally be from the market, or they're moving closer to medical services. When we looked at the zip code of origin, there were 8 zip codes that you can see on the map here that are highlighted yellow. This is where 71% of your residents currently originate from. So it's right in that sweet spot of 70 to 80%. So when we looked at the zip code of origin, you do get some people from New York, you get some people from neighboring zip codes, but it's not a significant population living in your nursing home, so it's not what we consider part of the market area. That would be the 20 to 30% that are coming, that originate near, but not in your market. Maybe they're moving here to be near adult children. When we look at any skilled nursing facility, likewise, if we went and looked at their zip code of origin, they likely would not be drawing very many people from this area. Their sweet spot would probably be 5-10 mile radius around their skilled nursing facility as well. There are what we call natural and geographic boundaries. Oftentimes rivers, lakes can be big boundaries where people just don't cross them. Highways, freeways, states are a big boundary. People will cross states for some services, but they tend not to move across as often for services. It does happen. There are exceptions, but states do tend to be a pretty big boundary. On slide 8, we'll talk a little bit about the competitive performance. Nathaniel Witherall does a really nice job of attracting residents from the local hospital, Greenwich Hospital. Whenever we look at a market, we want to look at what hospitals are in the area and where we're currently getting residents or the short-term Medicare rehab individuals from. In order to be a Medicare rehab individual, in most situations you have to have a 3-night stay within the hospital until Medicare would cover your stay in the nursing facility. There are some exceptions depending on the insurance you have. Greenwich Hospital discharges slightly more than 1/3 of all its discharges to a skilled nursing facility. So about 1 in 3 of their Medicare fee-for-service discharges are discharged to a skilled nursing facility. Nationally, it's about 1 in 5. So your hospital really utilizes the skilled nursing facilities at a much higher rate than national. This is a good thing. They recognize the effectiveness of discharging people to the nursing home. And when we get a little bit further down to this slide, we're going to talk about some of the reasons for that. But about 21% of the beds in this market are actually Nathaniel Witherall beds. Our primary referral source, as we mentioned, is Greenwich Hospital. 83% of our Medicare fee-for-service discharges come from Greenwich Hospital. It's very typical to have 2, maybe 3 primary referral sources when we're working with hospitals. Whenever a nursing home is located in a market with a hospital, that hospital is always going to be its primary referral source. Stamford Hospital accounts for about 6% of the Medicare fee-for-service referrals. So 89, roughly 9 out of 10 of our Medicare fee-for-service referrals are coming from either Greenwich or Stamford Hospital. The other 10% will come from hospitals that might be located near here. They could be people that were in another town or community. Something happened that necessitated a hospital stay, but they chose to come back to the community to do the rehab. So it's a very good question. So he wanted to confirm when I was referring to rehab, I'm referring to orthopedic, medical rehab. So the Medicare stay or rehab, short-term stay, is Medicare will cover up to 100 days of care. Depending on the type of care you have, orthopedics is a big part of it. Medical care could be a big component of that. But that's correct. So when we're referring to rehab, we're referring to the Medicare short stay rehab. It'd be both, correct. Nathaniel Witherall has excellent patient outcomes when it comes to the rehab focus areas. Compared to other skilled nursing facilities in the county, TNW has a relatively high market share for rehab after elective joint replacements and major jointless spinal surgery. And Nathaniel Witherall discharges a much higher percentage, so 78% of the Medicare fee-for-service patients after their stay at a nursing home are actually discharged back into the community. If we take the overall average in Fairfield County, it's 72%. So again, about 4 in 5 Medicare fee-for-service patients cared for at Nathaniel Witherall that do their Medicare stay are then discharged back to the community. That's higher than the county average in general. We do. The question was, do we have any readmissions data? The answer is we do. So we don't have that detail in this PowerPoint. We have a very large report that has the readmission based on different diagnoses. Mm-hmm. Okay, that's an excellent question, or excellent point. So the question was, when we're indicating that the Nathaniel Witherall discharges 78% going back to the community, where Fairfield County's average is 72%, does that necessarily equate to a higher readmission rate? The answer is it depends on the diagnoses. So when we look at each diagnosis, we looked at readmission, 30-day readmission rate, to be clear. We also looked at the average length of stay within the skilled nursing facility. We looked at home health as a secondary post-acute setting. We looked at market share. So when we looked at market share, first of all, Nathaniel Witherall had very high market share in a couple categories, as we mentioned. the elective joint replacement and major joint replacement spinal surgery. Overall, your average length of stay is a little bit higher. It's not significant. 30-day readmission rate, depending on the diagnosis. There's some that are a little high, some that are a little low. Again, we have the details in the report. And then home health is a secondary post-acute setting. Depending on the diagnosis, again, some might be a little bit higher than average, some might be a little bit lower. It's not necessarily a good thing or a bad thing if it's higher or lower, but it is important. Hospitals are becoming more and more cognizant of the readmission rate and the clientele, not just the people that are going to be doing their Medicare rehab stay, but also the family members that are choosing the nursing home are looking at the average length of stay. And with some of this upcoming slides talking about PDPM changes going forward, there's even going to be more pressure to decrease that length of stay. Actually, in the MedPAC report, which is a Medicare Payment Advisory Committee, just reported last week that a few years ago, the average length of stay for a Medicare fee-for-service patient nationally was 27 days. In the last reporting period, it went down to 25 days. We're going to continue to see that length of stay decline for those overall Medicare patients. There's more of a desire for people to get home sooner. And with advancements in technology and alternative options, we're able to get home in sooner, and especially with the help of things like home health as a secondary post-acute setting. There might be some individuals that are going to have their rehab within the nursing home. It might only be here for 5 days, where they might have used to been here for 10 days. They might be here for 5 days and now go home with home health to finish that episode. Yes. Darren, can you hand me that report? Page 43? Yeah, thank you. It's actually page 40. Page 40, table 28. Oh, is that better? Is this better? I got to work on my singing skills to get a little closer here. The market share varies depending on the diagnosis. When we looked at the major groups, we actually looked at 6 different major groups. Elective joint replacement, T&W actually has a market share from the overall 2 hospitals, to be clear, of 50%. So of those 2 hospitals, half of that patient clientele for elective joint replacement is coming to T&W. That's an outstanding market share. Acute neurologic, about 10%, major joint replacement surgery, about 30%. But overall, it's about 20% from those 2 hospitals. Now, we did narrow that down to people that are returning to the community. We did not include people that transitioned to long-term care or originated from long-term care. And the reason we didn't include them in that analysis is because if a person is already living in long-term care and then something happens that necessitates a hospital stay, when they go back to the nursing home to do the rehab care, they're going to go back to the nursing home that, for all intents and purposes, is their home at that point. There is opportunity, but I would also mention, remember when we looked at your market area, there's 6 other nursing homes also going after that clientele. And then a hospital's market area is different than a nursing home's market area. A nursing home market area typically is going to be no more than 10 miles. If we went to the hospitals and asked them their market area, their hospitals are going to be much more significant than that. They're discharging people north, south, east, west. They could be going out 15, 20 miles. So we're not just competing against the nursing homes in our direct market. when it comes to the Medicare focused population. So the answer to your question, is there room to increase market share? The answer is yes. There is room, there's opportunity, but there are some areas that we would recommend looking at that have high volumes that could be possibilities. When we specifically look at Table 32 on page 43, when we look at the opportunities for improvement, we actually identified from Stanford Hospital and Greenwich Hospital some major groups that the between the length of stay readmission rate were a little bit higher than market average. So there's actually room for improvement from the hospital standpoint, where there's an actual interest for them to improve their outcomes. And so that's an opportunity to work with them on those specific diagnoses. Mm-hmm. Mm-hmm. So his point is that I absolutely agree. There's a lot of patients to go after. When we looked at the demographics and calculated what the demand's going to look like in the future, we're looking at that population, which we're actually going to talk about on slide 9, and how that's going to impact going in the future. So,
Stanford Hospital has the Von Munching Center for short-term rehab. It's an acute rehab facility, and it does include things like cardiac rehab and things like that. Did you look at that facility in making your recommendations as to, whether or not Nathaniel Witherell can compete with that?
So the short-term answer is we didn't go into each individual facility, look at their specialties. What we looked at was how you compared to the market, what the volume is, and what your outcomes are to identify opportunities for you. So
Okay, but I guess my question directly relates to the number of referrals from Stanford Hospital. If they have their own facility, will we necessarily get those referrals, especially for acute, short-term?
It's going to be a minimal amount. So a majority of your population, as we mentioned before, about 80% are coming from Greenwich Hospital. Less than 10% are coming from Stanford. So we're not getting many referrals from them. We're likely not going to increase very much from that hospital, but occasionally we're going to have people going back and forth between the hospitals where we can capture some. Right now, it's about 10% of what we're capturing. Not market share, but about 10% of our referrals come from them. If we were able to show them, and there are areas that we do excellent outcomes in, that there are opportunities for some of their clientele that do live in this area to come back to this area rather than stay there. It's not going to be your bread and butter. It's always going to be Greenwich Hospital, but there is some small possibilities, yes. On slide 9 here, we're going to talk a little bit about the increasing pressures on capacity and utilization. There is really greater challenges in maintaining relatively high capacity of utilization. This is not unique to this market. Really, if you go to any nursing home anywhere in the country, they're facing similar issues. When we look at the demographics of the market, this is, again, that yellow highlighted area that we looked on the map that we identified as your market area, where 71% of your clientele originate from. In that yellow highlighted area, we wanted to take a look at the demographics. When I look at demographics, I always tell people it's very important to know what the demographics look like now. It's more important to look what those demographics look like in the future. There are right now approximately 157,000 individuals that live in that yellow highlighted area, identified as your market area. About 11,000 of them are age 75 plus. Now, in this country, when we talk about seniors, we typically identify a senior as age 65 plus. But a 65-year-old tends to be very independent and doesn't need a lot of services. As we age, we start to need more services. At 75 plus, we start to use a little bit more services, but really it's the 80, 85 plus population that is utilizing nursing home services, assisted living at the highest rates. The average age for someone even going into independent living or assisted living is about 80, 81 years of age these days. When we look at that 75-plus population, which is typically identified as more of a target population, we're seeing that population grow over about 7% over the next 5 years. So really, really looking at that, we can determine with an increase of 7% over the next 5 years, we're going to see an increase in the need for overall senior services. When we also look at that 85-plus population, we're seeing that population decline about 4% over the next 5 years. To put that from a comparison, nationally, the 85-plus population is increasing 5.5%. So nationally, the highest users of services is increasing about 5.5%. Locally, it's declining 4%. Mentioned earlier when we looked at the occupancy that was a first indicator that there's some excess number of nursing home beds in this market. When we're looking at future utilization of skilled nursing facilities, both from long-term care and short-term care, seeing a decline in that 85-plus population, which is, again, the highest users of services of those services, seeing a decline in that indicates we're going to see more of a decline in the need for services for that particular skill set in the future. Now, again, when we looked at the 75-plus population increasing, that does mean an increased need for senior services. Senior services could be low-income housing, could be market rate housing, assisted living, memory care, home health, home care, hospice. But when we're looking at skilled nursing facility in particular, that 85-plus population makes up a significant population in our skilled nursing facilities. A decline in that population will result in a decline in the need for beds in this market. To look at historical perspective, we looked at the state of Connecticut, and we looked at the ratio of seniors per occupied bed. In this case, we're identifying seniors age 65 plus. In the year 2000, there were 16 seniors, again age 65 plus, for every occupied bed in the state of Connecticut. During that time, we've seen a significant increase in the number of seniors, but we've seen a decline in the actual census of nursing home beds overall in the state. And the reasons for that are multiple. There are more options for services. Again, independent living, assisted living, memory care assisted living, home health. There are more options for people to either delay or even not go to the nursing home entirely. Other Medicaid, home and community-based services are providing services, keeping the Medicaid population in the community longer. And the states are putting a lot more money into those long-term Medicaid, home and community-based services than in the past. In 2017, we have about 26 seniors per occupied bed. Again, in 2000, we had about 16 seniors per occupied bed. By 2017, we had a decline in utilization to the extent that there were 26 seniors per occupied bed. If we continue on that pace, by the year 2023, there are going to be 34 seniors per occupied bed. Now, we mentioned again that there are more alternatives for a population. But we also have to look at the clientele themselves. If you have the option to live in a nursing home or an assisted living facility, or you have the home care options to stay at home, many people are going to choose to stay at home as long as they can. So it's also a desire of the population to delay that as long as they can. The length of stay in a long-term care facility for both a long-term care patient as well as a short-term patient continues to decline. So it's not just a decline in utilization. The length of time that they're in the facility is also going down as well. On slide 10, we're going to talk about increasing financial challenges. We are in a very highly regulated business that has an expansion of independent living facilities, assisted living, and at-home nursing home services. Even if we're able to maintain our current capacity of utilization rates, there will be an increasing pressure on our revenue sources. Reimbursement rates for Medicare and Medicaid are regulated. In almost all long-term care residents have Medicaid. As we mentioned earlier, it's about 2/3 in this market, a little over half in Nathaniel Witherell. And this offers a lower reimbursement as compared to Medicare or private pay individuals. Most short-term rehab patients are either traditional Medicare fee-for-service, Medicare Advantage, or private pay, and these are higher payers than Medicaid. In October 2019, Medicare is changing its payment system from the current resource utilization groups, or RUGs as they're more commonly referred to, which focuses on physical, occupational, and speech therapy. And it's going to be going into the patient-driven payment model, which will be focused on time spent on nursing and therefore may reduce reimbursement rates. You think that's a jump? Well, according to CMS, when they laid this out, it's supposed to be budget neutral nationally. And all skilled nursing facilities, of course, are not equal in that change. CMS did estimate what the reimbursement difference would have been in calendar year 2017. And looking at that, your neighbor New York is actually the state that's going to lose the most in that. Actually, a lot of the states on the coast, both coasts, end up losing in that. And then it's a lot of central of the United States that ends up winning. So according to CMS, it's going to be budget neutral. But we will have to see. But there is going to be a new focus on particular patients that weren't focused on in the past. On slide 11, as we mentioned before.
Sorry, can I just ask a qualifying question on that?
Yes, please.
Even if it is a jump in your conclusion, is there a chance that Nathaniel Witherall's reimbursement rate would increase? So I think you make the assertion that reimbursement rates most likely would decrease.
Mm-hmm.
Is there any chance that they would increase over where they are? Or is the best case scenario that they would stay stable, essentially?
I will refer Darren to that, who's actually our PDPM expert.
I understand the question is what will be happening with the rates with the implementation of PDPM, correct? And is it likely that they will remain static, go up, or go down? I think the prior report that we drafted indicated that based on current dynamics and current behaviors, that reimbursement would decline and have a $200,000, is that our number, Kathy? I believe it was a $200,000 negative impact on the rates for Nathaniel Witherell. And what's driving that is the shift in the reimbursement mechanisms that are driving additional reimbursement over to providers that are focusing on and have a broader bandwidth in caring for more clinically complex patients versus just those short-term, primarily rehab patients whose rate is being driven exclusively or nearly exclusively by the delivery of very high volumes of therapy minutes. So can the rate go up? Could, if behaviors change, if the dynamics change. Can there be a net gain in reimbursement? There could. What's happening, though, is that the residents that are short-term rehab in nature are getting very expensive therapy services. Those very expensive therapy ancillary services are converting to very high Medicare rates. That is all getting rebalanced as part of PDPM. So providers, we anticipate, will take a different approach to how they deliver therapy and rebalancing their cost structures and how they operate the delivery of care. Less focus on therapy, enough therapy to meet the appropriate patient-resident outcome, but the right outcome doesn't always have to come with it 720 minutes of therapy, which is the ultra high level that typically is being passed around right now. Maybe. Yep. Right, right. You can prepare my notes next time. That was well said. Very well said. No, I'm extremely bullish on PDPM, but I think it's going to require some work, and everything that you said is accurate, but it requires a heavy lift, because to transition, or as we say, pivot from a therapy-driven model to a clinically complex-driven model, it's hard to do, and it requires a lot of planning, forethought, training, education, strategy. Absolutely. So as an offshoot of that, what we're recommending from a consulting perspective is that to optimally position your skilled nursing facility for PDPM, you need to do a number of comprehensive assessments. Understand the market, understand what the discharge dynamics look like with your partner hospitals, understanding what those clinically complex patient needs look like that are causing pain points in the hospital, so that you can be first in line to take advantage of those opportunities. But it's very dangerous to say that you do a clinical program when you don't, and you start taking those patients, and your length of stay starts going up, right? Your rehospitalizations start going up, and you're not equipped to deal with those patients. So we're encouraging folks to get on board fast, understand their strengths, their weaknesses, understand what programming needs to be done, and start working on that transition as soon as possible. So.
Can I just ask a follow-up question to that? Are we talking about acute care or long-term care for these clinically complex patients?
Well, they're connected together, because the clinically complex patient in the acute care hospital right now many times creates a bottleneck or a challenge for the hospital to find placement. And under the DRG reimbursement, they get $1 amount, whether that patient's in for 5 days or for 25 days. So they're going to be desperately looking for partners that can accommodate those types of clinically complex patients faster, but more importantly, more effectively, and to deal with their clinically complex conditions in a way that keeps them in place and doesn't have them returning to the hospital within 3 to 4 days after they come into the
And just
into the
again,
nursing
as a follow-up, I guess my question would also be related. Von Munching in Stanford has those types of facilities for clinically complex, things like cardiac care, strokes, those types of cares. Would we be in a position to be competing with them? And I guess, does it make sense in the long run?
These are, Colin, these are hospital-based SNOs or SNFs that she's referring to? Or
Yeah,
standalone?
Von Munching is associated with Stanford Hospital, but it is a rehab facility within
Do we have anybody
Stanford
from that
Hospital.
hospital in the audience? Because I'm about ready to say something that might not be too popular.
No, I mean, I'm just asking the question because they
Yeah.
do have the facility. It's highly rated. People rave about
Yeah.
it. And
We consult all over the country, and what we find, and as more often than not, is the case that where you have a SNU or a SNF, which is a skilled nursing unit or a skilled nursing facility, owned or attached to a hospital, that the dynamics sometimes are not good. And there are a lot of opportunities for independent, other standalone facilities to come in and get a lot of business. A lot of times hospitals use their own SNUs or their SNFs to take those patients that perhaps don't have a payer source. They're trying to find a location for them because they don't want to spend $2,000, $3,000 for them to be in the acute care bed. So they put them in their own skilled nursing facility. That's one of their solutions. That's a sizable strategy for a lot of hospitals. But just a lot of times the dynamics. Hospitals typically don't know how to run skilled nursing facilities, and they don't know how to manage them. Then they don't know how they can benefit one another. And that's sometimes that relationship gets mismanaged, and a well-run organization, independent, can come in and take advantage of that situation and create opportunities for themselves. Uh-huh. Well, I'd have to refer to you on table 28, but it sounds like, again, as I said, I'm bullish on this whole concept for those that are willing to, again, as I say, make the pivot, develop the clinical program. I don't think you should go down that path if you're just going to claim to be something and not be it, because it'll come back to bite you in a big way. But yep, absolutely, absolutely, absolutely. Very bullish on that. Yep. There. Okay. Thanks. Sorry, Colin.
And then that'll bring us to slide 11, which is a prospective revenue and cost pressures. So as we discussed earlier, there are alternatives to nursing home placement. Those alternatives tend to be, if you're looking at living in an alternative option, market rate independent housing, assisted living, memory care, assisted living. So we identified 7 that are located directly in your market. They have varying degrees of the types of services and how large they are. You can see some of them are standalone, some of them have all 3 options. So there are alternatives to nursing home placement, which is another reason why we continue to see utilization declining. Nope. Nope. That's a complete. I should say. He mentioned that doesn't necessarily impact the shift from PDPM. No, this is going to impact more of the delayment in a long-term care placement. Again, the average length of stay in a long-term care facility right now is approaching 2 years. It used to be a much longer length of stay than that, so people are delaying the nursing home placement as long as they can because they have alternatives like assisted living, memory care assisted living that can care for a higher level of need, but not necessarily a nursing home level of care, but a higher than they can at their own home. There's potential. Partner with the facilities to become their provider of choice. So when their individuals do end up in a hospital and need nursing home placement, that they're choosing to come to Nathaniel Witherell. Another option is we did do a demand analysis. I don't know if it's an avenue that you're looking at pursuing, but there is opportunity to develop additional senior living opportunities in this market. We simply did did we find encouragement? The answer is likely no. It's simply a quantitative analysis. Looking at the individuals, we looked at age, income, and disability qualification by the number of individuals. Again, we look at what the opportunity is now, more importantly, 5 years from now, and that population is increasing. Again, we looked at that 75-plus populations increasing, which does result in an increased need for senior services. The 85-plus is declining, so we're not seeing a significant increase in senior living opportunities. But if that was an avenue you wanted to pursue from a quantitative standpoint, there would be opportunity to further explore looking at senior living opportunities. And then that brings us to slide 12, where I'll hand it off to Stephanie.
Great, thanks, Colin. We're on slide 12. This is, we already kind of talked about revenue and payer mix, but this is a nice visual to see the shift from Medicare to Medicaid. Medicare being the orange bar and Medicaid being the gray. Medicare decreasing as Medicaid is increasing. The occupancy, as you can see, has stayed stable, but the shift from the to the lower paying payer from the higher paying payer is going to impact the revenue. Correct. Not necessarily. It's not going to be higher than Medicare, but it definitely is helping that we have seen a shift kind of in our line of work from Medicare to managed care, but the rates aren't usually as good. They're typically 85% of the Medicare rate. Sometimes you can get some commercial rates that are very nice, $600 to $800, but there's no guarantees, and it doesn't look like that's what is coming here. So we can move on to slide 13, which is showing the expenses and net income / loss, I should say. So this is a summary of the financials from fiscal year 2016 through 2018, showing the overall operating expenses. And I'm kind of focusing on 18 since that's the most recent, $29.5 million, which has stayed fairly consistent from the past 3 years. And then that brings us to the earnings before interest, taxes, depreciation, and amortization, otherwise known as EBITDA. $2.1 million loss in 16, and that did improve to a $1.5 million loss in 18. The financial statements prepared by the accountant, PFK O'Connor. Yes, correct. Yes, there was. Correct. Okay. Well, yes, that is correct. I believe everywhere, basically every financial table in this report is from the PFK O'Connor financial statements prepared. That brings us to slide 14. Our operational assessment uncovered some opportunities for greater efficiencies and cost reductions. The first item is to address labor costs and operational efficiencies. Wages and benefits, subject in this case to collective bargaining agreements, comprise over 70% of the total costs. They are high relative to area facilities. We saw some opportunities to adjust staffing levels. Another recommendation is to consider implementing a paid time off or PTO policy versus the current non-productive time off that's being used. Adjust new employee retirement benefits that are greater than industry norms, and do further analyze the high shift differentials. And then I know when we look at the overall wage, it's higher, so it's probably very likely. I can't get access to that data, no. You can't make phone calls and ask that data. We'll get to that very shortly here. The last bullet is to develop more efficient policies and procedures, which Kathy will go into in a little more detail further on regarding departmental budgets and then business office and accounting processes. So since the question came up about how much higher the labor costs are, we can start with slide 15 briefly, and then I kind of want to skip to 17 because that'll be easier to understand. But let me explain what I did here. I selected 8 facilities to compare Nathaniel Witherell to, which are all in the area and were selected by the committee. They're all listed on page 15 and 16. Greenwich Woods, Carlton, Waveney, Villa at Stamford, Dumont, Glen Island, St. Cabrini, and Andros. I took an average of those facilities, and then also I have access to Northeast benchmark data for 2017. This data is 2017 data, which is the most recent data available. If you want to skip to slide 17, you can see that every department, with the exception of administrative, the wages are higher than both the comparison facility data, both the average and the Northeast benchmark. And just to clarify, this is total wages. So that would include overtime, shift differential, all your categories divided by the hours. And that's what the cost report does not break out, productive and non-productive. So I can't break that out further for those facilities. I believe in the larger report, I did pull some non-productive benchmarks and looked at that. And we also looked at overtime, which wasn't too bad. So if you want more detail on that, you can refer to the larger report we did.
Can I just to clarify on that as well, since the question was raised before, this data, where did you get this data from? This data is from what was filed with the state, correct?
So nursing homes are required to file Medicare cost reports on an annual basis, and that's where I received that information from. And
from their state regulatory filings. From the
they're federal. The cost
federal.
reports are federal.
So
yes.
what the nursing homes filed
submitted
themselves.
to the government, CMS, correct. Centers for Medicare and Medicaid, correct. 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 No, we can't.
Can I ask another question about trying to understand if there's a bias in looking at the comparison facility average? The average, the centers that you looked at to look for other rates at the different positions are different quality level nursing homes. There's some 2-star, 3-star, a variety. Would there be a relationship with the rate that they pay to a position and the quality of care they're providing that then biases the wage
It's very
rates?
possible. We made very sure we pulled only, I believe it was higher, 3 or 4-star. We did not pull, we took out any 2-star facilities. I believe even 3-star were not included. And we looked at the staffing star level, not just the overall star level, to make sure that we were comparing similar facilities. The most recent that's posted. Well, that's what's available right now. So that's where that data comes from. We can go on to slide 18 unless there's any more on that. Can you please repeat the question?
Just for overtime.
There's no way to do that.
So it's possible that we may have less overtime and that they may have more overtime and that overtime could therefore result in an equivalent cost.
Yes, that is possible. We did do a second analysis where I pulled from a software company called Pay Factors, and I only included the base rate, which would not include overtime. And those rates were higher as well. And you can find that table in the large report. I don't know the exact table number, but that analysis was performed as well.
If I may, on chart 16, you use Glen Island, that's in New Rochelle, or Pelham, if I'm not mistaken. And you use St. Cabrini. Why did everything you've seemed to do, you've been talking about this catchment area. Why we're exceeding that catchment area on this particular, what was the objective there?
Again, we agreed on these facilities with the committee. We went through similar size, Medicare volume, location. We went through a very extensive process and 3 or 4 versions of what facilities we chose. I do have some others that I pulled before we agreed upon it. And these are just what we had decided on to review.
And is there anything in there to divide this by the patients, number of patients served per that average hourly cost? Is that in there?
The large report has a cost per patient day comparison for probably some different set of facilities. We chose certain facilities for wage and labor analysis and certain for cost analysis. I can't remember off the top of my head which facilities for which, but I have it in the large report, which facilities we compared for each analysis. And there is cost per patient day analysis, which were higher in most of the buckets as well.
Stephanie? Can you just go back over? My understanding is that the whole STAR system got stopped because they're readjusting and that it's going to start up in April of 2019.
Yeah, Kathy's going to talk. The question was
Okay.
about the star ratings. We're going to be going over that shortly in the next section, if you don't mind. We have a pretty extensive section on that actually very soon here. So if you could just hang tight with us, we'd appreciate it. I did, but it's on my laptop, so I'd have to get back to you on that. Yeah. Oh, sorry. The question was if we did any analysis on the impact of right-sizing the wages. And I believe I did it on my computer, but I don't have the numbers in my head right now. So I can look and get back to you.
On page 26, I think you get to that point, when you're making some analysis on recommendations.
Yes,
It doesn't
yes.
exactly respond to the doctor's question, but it does partially. And maybe you'll
Correct,
get to
yes.
that later.
Correct. So moving on to slide 18. Here what I did is looked at the overall benefit costs, and I compared Nathaniel Witherall to a different set of comparison facilities because we did not, I don't have access to New York data, I only had Connecticut data here. So we selected the Connecticut comparison facilities that we used in the other analysis and pulled the detailed benefit costs from the Medicaid cost report this time for the various buckets. And basically what this showed us was that the health insurance and the pension percentage of salary is higher than the comparison facility average. I also included our facility percentage of salaries as well for a comparison, and it's higher than those as well. Yes, very good point. The point was brought up that the workers' compensation costs are lower at Nathaniel Witherall than the comparison facilities, which is a good indicator of a safe environment, and yeah, very good indicator for the facility. I don't have the slightest idea. I mean, I have a schedule. The question was, what kind of insurance do we provide? I would say competitive, because our benefit percentages are comparable to our peers. Oh yeah, we definitely include all of the typical insurance. You know, what it might come down to is what percentage is paid. That could be. I didn't have that detail to look at that. Just other factors. Our wages compared to yours, I didn't do that because we're mostly in the Midwest. That wouldn't really make sense. Oh. Somewhere in that range, probably, yes. Okay, I guess there's no question, just a comment that these numbers are incomprehensible. Yes. I do know the numbers. I have the salaries and I have the benefits. And I don't have that on top of my head. Sorry, sir. I help 30 of our buildings. I couldn't possibly know that. All right, I'm going to turn it over to Kathy now. Any more questions on the benefits?
May I ask just another question? Before was about right-sided thing, and I think it was wages. But you've talked about the different type of payer types, but have you talked or evaluated for, say, the different types of business? You know, the rehab business, associating those revenues and the costs or the additional labor costs of staffing a rehab unit versus a long-term care. And does this mix of business also vary as you're comparing Witherall to these other facilities, be it the market or be it, you know, the HDGs? Have you looked at that change and that mix, and whether there's, you know, I mean, you use the word right sizing, but, you know, in terms of that kind of perspective versus purely the revenue mix?
We compared the costs as best we could, ma'am. I don't know how to answer that question. I mean, we do consider payer mix and all of that, but we don't have that level. I don't have that level of detail with the cost data that I'm looking at, so I can't go into that level of detail.
Thank you. Right. And, well then, may I ask one more question related to that? When people are looking at their skilled nursing facility changes of businesses, are they then risk adjusting those numbers for exactly the point that's being raised here?
I'm not sure I understand the question.
Okay,
Right.
thank you.
I think generally in these types of analyses that are more descriptive, there isn't that type of risk adjustment.
I mean, that would be very qualitative.
Yeah, if you could repeat the question or the comment.
Summarize the question was the wages and salary data that we looked at, was that adjusted for medical risk of the patient? Because you can imagine that a sicker patient or sicker patients would need more overtime, etc. And so in order to really do an apples-to-apples comparison of Nathaniel Witherall to other nursing homes, ideally, perhaps the data ought to be risk-adjusted from a medical perspective. The response was no, the data aren't risk-adjusted.
But can I just ask, David, use your mic. Can you, mic, please?
If the risk of the patient, if the patient risk at Nathaniel Witherall is lower than in the average and the composite, then one would think that Nathaniel Witherall would require less overtime, and that since the overtime costs are higher, regardless of the fact that the base is lower at Nathaniel Witherall, then the overall wage cost at a competing location could be worse because their risks are greater than at Nathaniel Witherall. Is that your point? Am I getting it right?
Well, I think I took it more simply, David, because I only compared long-term care versus rehab. So really, there were, you know, maybe two risk groups, but that work was not considered, and she would find it difficult to do. So I think then it was carried to a different level.
So if you're asking the question of whether we could compare short-term costs to long-term costs, there is no data available like that in the cost report any longer because everybody lumps it all together. 5-10 years ago, people had what was called a distinct part where all their Medicare patients were, so then I could take that cost report data and report that back to you, but nobody does that anymore, so they're all kind of lumped together, so you'd have to go through a subjective calculation where you'd be applying a factor for which I think it is proven that Medicare patients need higher nursing care. There's no doubt about that. What that is, that would be pretty subjective to determine that.
Thank you for that additional clarification.
No, I think I finally understood what you were saying, so sorry. All right, I think we're ready for Kathy.
I'm going to First of all, can you hear me? No, not over there at all. Very close. Now you can hear me, right? Okay, let's see if I can do this. That's probably what I should do, shouldn't I? Just take it off there. Break it. Okay, I'm going to try to do it this way and see if that helps. I'm going to start by talking about staffing. So there's two slides that I want you to look at. Well, first of all, I should tell you I'm Kathy Carr, and I am the VP of Consulting Services for Health Dimensions. I have been with them for 6 years plus. So what we're going to talk about are two things. Number one, you're going to see a slide behind me that will show 3 tables. I am going to flip to slide 20. And on slide 20, if you're looking at the table, I am going to explain the tables that are on the slide 19. Generally, higher staffing levels are an issue at Nathaniel Witherall. Comparison between the current labor usage and the labor usage for 4-star and 5-star staffing ratings show that TNW have a higher staffing level. TNW's total direct care staffing hours are currently at 4.45 per patient day, or PPD, or 823 hours per day in a 24-hour day. Hours needed for a 5-star are 415 PPDs, or 768 hours per day. Hours needed for the 4-star are 3.50 PPD, or 648 hours per day. RN staffing combination of the registered nurse and patient care managers, which are the PCC, on your list on the table number 3, show the highest opportunity for adjusting staff and achieving cost savings. In the 5-year projection that you'll see later on in this presentation, HDG used a 4-star staffing level at 0.62 for RNs and 3.79 PPD for total direct care staffing. So on the table, the CMS staffing star rating comparison for the first table that's what CMS says that you need for a 4-star. It's a 0.50 for RNs in combination with the total direct care staffing of 3.50. For a 5-star, it's 0.74 with direct care staffing at 4.15. The overall staffing rating is a combination of the RN and the total direct care staff. And CMS does give both of those areas, the RN staffing and the total direct care staff, equal weight when they're looking at your star rating for staffing. That's all right. CMS staffing star rating for Nathaniel Witherall for the RNs, based on your leading age report that Nathaniel Witherall uses for monitoring and assisting them in maintaining their star level, was at a 1.301 for RNs. So if you compare that to the staffing of either a 4-star at 0.50
or the 5-star at 0.74, you can see that there's opportunity for staffing reduction in the RN area. For the total direct care staffing at 3.35 at 4-star, or the 4.15 at the 5-star, Nathaniel Witherall is running 4.445. So you can also see that they're running higher than the 4 and the 5. So just so you could understand it, Leslie, did you have a question?
No, well, I wanted to know, is it on? If that's, again, related to the risk level of the resident or patient, or do you think it's other reasons in this case?
Well, in this case, because I was on site at the time that this assessment was completed and actually looked at several of your residents that you were caring for at that time and looked at the basic acuity that you had in the facility at that time. And I would say you guys do a great job with like the hips and the knees and the surgical patients, the rehab patients. You have a great rehab and great rehab results. But just because they're rehab doesn't mean that they're high acuity. So I think that there is opportunity to reduce your staffing.
Thank you.
Okay, we're going to try this one. Is that a little better? It's worse. It's worse? All right. Yes. I think that when there's multiple levels, your staffing levels might be a little bit higher, and I see it more in the areas of like the direct care staff, because if you have to have, meaning like the CNAs, and you have to have them on the floors to give the care to the residents, it's hard that if your census is down in one floor, you still have to care for the residents that are there, and you have to have the staffing ratios equal. So you can't, what I would say, cut somebody in half to have them work 2 floors. It's kind of a challenge there. But I do believe that there's still plenty of opportunity to reduce your staffing. Well, if you see it even right in here, I broke down what your staffing hours are down below. I did not provide that for this report or for the big report. I didn't go into that much detail. We could, absolutely, if you would like for us to do a full-blown staffing assessment. I can look at that and give you some recommendations, yes. I can. I have your ratios that were given, based on the ratios that were given to me, that you would have X amount of staff on this unit, and you have X amount of staff on that unit. I can give you direct recommendations of where I would reduce, yes. Okay, we'll get that.
I'm sorry. Yes, I'm sorry, but we're just taking questions from the 2 boards at this time. If you want to.
So should I answer it? No, okay. Okay. So Colin, can you go to page 21? Oh, yes. Yes, ma'am. Yes. No, that is not an error, but thank you for asking that. If you would add the RN and the PCC together, they will come up to that 1.301 because all the PCCs are RNs. And they are counting them in their staffing for their star rating. Right. They are RNs. So on page 21, we're going to talk about expense control. We talked about one of the things that's really important is to make sure that the departmental budgets are provided to the managers with the budget for their Pacific unit at or prior to the beginning of the fiscal year. Your fiscal year starts July 1, and for them to be able to monitor their expenses appropriately and keep on target, they need to make sure that they have their budget. It'd be nice if they could get it in June, so that they have it ahead of time to prepare their, what I would call their expense or their checkbooks for what each of their areas that they're going to be responsible for, so that they know what their PPD would be for those expenses. Did I see the departmental budget? No. You have a CFO that should be able to provide that information. Not for sure I'm understanding your question.
A question was asked earlier about whether the recommendations that you're about to make is standard practice. Maybe you could talk a little bit about their facilities and whether these kinds of recommendations would be considered standard business practice.
Yes, I can talk about this being standard business practice. In most of the facilities that in all facilities that we work in or that we do assessments in as consulting, is that they have a budget, like a yearly budget that follows, and these would be their revenues that they expect to bring in, and these would be their expenses that they expect to spend during the year. Each department manager is responsible for areas in their department, such as, if we just talk about nursing, nursing would be responsible for the medical supplies. They would be responsible for knowing the budget for oxygen. They would be responsible for knowing the budget for medical equipment. And they would be responsible for ordering supplies and making sure that they stay within that budget, unless for some reason they would go over for the care of a patient. And then that would be a conversation with their executive director or their administrator. So it would be standard of practice to have that. And most organizations then also have what they call a spreadsheet or a checkbook, where it's automated, where you would go in and put in your PPD, and this is the amount you have to spend. So every purchase you made, you would record that purchase and show what you had spent, and it shows what you have remaining for that month. So that would be the standard practice. I did not see those practices at your facility when I was there doing the on-site assessment. Okay.
So, Kathy, sorry. When you met with the individual departments, did you ask that, even though you didn't see it, did you have a conversation with the departments about whether they actually are involved in the budgeting process?
Yes, I did. I asked every single department, and I talked to every single department, and not one department was aware of their budget with the exception of one, and one person had actually been given the budget, but it was the day before when I had already started asking for it. And so they had went over the budget with her before she came in and talked to me on the third day that I was there. So paid benefits, adjust T&W's paid benefits that currently are at 38.3, the cost report period ending 9/31/17, as compared to the comparison local communities that run at a 33.1. The Northeast benchmark is 20% and the national average is 17.4. Staff wages, adjust the wages for new employees in all departments which are higher than the 8 comparison communities as well as the Northeast benchmarks. Costs per resident day, take steps to reduce T&W's cost per resident day by department, which runs higher than their competition and industry medium. Nursing staff, manage the nursing staff to the daily census. Currently, the nursing department is staffing direct care staff above the CMS 5-star level. And I understand that you do have a union, and I know sometimes that you cannot maybe send people home, or you can't adjust if they're already there, the staff, because of the union requirements. So at times you may want to think about staffing at the very top of a 5-star or maybe even the 4-star, and then if your acuity picks up or you have a change in the medical care that you have, you can always adjust by using per diem staff to bring in more care if it's needed based on the care of the residents, so you're not jeopardizing quality. I'm going to talk a little bit about the business office. It depends on your base rate for your per diem staff.
Question, sorry.
Oh, I'm sorry. She asked if the per diem staff were cheaper than paying overtime for your current staff. And I said it depends on your base rate for your per diem staff. There are also agencies. Okay, for the business office and accounting, the admissions and census. So the admission and the business office staff should work as a team to ensure all necessary information is received and uploaded into the billing software and shared with the billing staff. Complete an insurance payer verification form for each potential admission prior to accepting the new resident. Complete an admission agreement for every admission within the first 24 hours if possible, but at least within 48 hours. Resident trust. For Medicare residents who have chosen to deposit their Social Security check into the resident trust account, the RTF, ensure the RTF shows the total Social Security check going into the RTF as a deposit, with the amount for care withdrawn and paid to the facility. Refund all RTF balances and discharged deceased residents within 30 days or discharge or death per the federal regulation of 483.10 F10 Roman numeral 4. The notice of certain balances. Ensure that the RTF never goes negative. That's really important because you're dealing with the residents' money and you're the keeper of the residents' money, so that should never show a negative balance when you're having an audit. The business office and accounting, the billing and collections policies and procedures. The Medicare biller should schedule a triple check meeting for the same time each month for the Medicare and managed care claims to be submitted before they are submitted. The triple check, if you haven't heard that before, is actually a tool that is used to make sure and to validate the accuracy of your Medicare and Medicaid claims. So you want to make sure that that's done before you're submitting those claims. You were not, no. At the time that we were on site in September, you were not. Review copies of the minimum data set, the MDS verification report, to verify that the MDS has been submitted and accepted by CMS prior to submission of any claims. Hold a monthly account review meeting with the business office staff, administrator, and chief financial officer, the CFO, to accomplish the following. Clearly define credit balances due to the residents or insurance companies and process the refund within 30 days. If it is determined that they are due to the resident or insurance company, refund the credit balance as quickly as possible to comply with the CMS mega rule within 30 days of discharge or death. For the accounts payable, make sure you're completing the Office of Inspector General, which is the OIG, verification for all vendors prior to employing or contracting with them. The reason for that is because it's the check to make sure that the vendors that you're using do not have any fraudulent activity against their business or them personally.
So this was one that I noted in your other book here, as well as the slide. So can you elaborate on that? Do you think that there might be, I mean, why are you raising this particular issue?
The building was not running the OIG prior for their vendors and before using them, and they don't have the OIG check for the vendors that they have in place. And it is a requirement that you have that with the government. You should be checking it.
So it's government requirement that Witherall is not meeting.
Right.
And might there be fraudulent issues that you don't know?
I don't know that.
Okay, thank you.
But thank you for asking the question. I'm going to turn it over then back to Stephanie, and we're going to talk about the strategic options for Nathaniel Witherall. Thank you for your attention. Yeah, let me talk real quick about the 4-star or the 5-star. Currently, right now, starting in April, the 5-star will be released. Right now, it is on hold for the 5-star, and it is going to be back in place in April. It's been on pause for about 13 months, and the reason for that is for the 5-star staffing. It is that they started what they called PBJ, which is the payroll-based journaling. And they wanted to make sure that CMS, when I say they, it's CMS, wanted to make sure that the information that they were receiving from all long-term care facilities regarding their staffing levels was accurate. So it used to be that they would come in for their annual survey and they would hand you a piece of paper and they would give you 2 weeks and they would say, you need to fill out your staffing that you ran during these 2 weeks' time. And what they discovered is that some of the information was not being reported correctly, or that people would actually staff up knowing that it was the time for their annual survey. But they wanted to make sure that staffing has been being ran continuously at the same all the time. So they have required long-term care now to report on a quarterly basis all of their staffing. It has to be sent in. And it is called PBJ for short, or payroll-based journaling. But then they also put all the star rating on hold because of the fact that they wanted to make sure that they got through enough cycles so that when they started looking at the facilities again and rating them, that they started rating them again, that they would all be on an even playing field and that they would be comparing apples to apples.
Just one follow-up question on your recommended changes. There are additional recommended changes in the book that you haven't put up here. Is that correct? And it's in the big report, and people should go through it just to make sure they understand it. Thank you. Okay.
You'll be gratified to know that one of the items on the budget before this board to be voted on at the end of the month is a capital expenditure to renovate the sound system before we're doing this again.
Yes.
To which I'm voting against.
Budget item approved. So the last section of our report is the 3 strategic options we were asked to review. The first option is to continue as a town-owned facility, seek greater efficiencies in the operations, and we're calling that the as-is scenario. The second option, a sale or a lease to a 501c3 not-for-profit corporation. And third option that we were looking at, sale or lease to a for-profit corporation. Some of the key attributes to consider in these 3 scenarios. The first one is being part of the fabric of the town. Obviously, the current scenario, that's very important, and that certainly would continue. Likely to continue under a nonprofit or 501c3, maybe less likely under a for-profit manager. Second item, employee cost structure, as we've talked about before, higher than some comparison facilities, as is, not likely to change. And under a new ownership structure, there is, some more potential for reductions there. The possibility for tax-deductible contributions, not an option currently. That would be an added benefit to being a 501c3, and obviously not an option for a for-profit manager. No one likes donating to for-profit operators. A focus for quality service. Definitely more likely as the current scenario, and a 501c3 corporation, probably perceived less likely for profit. The potential for economies of scale, not as likely keeping things as is, but obviously some opportunities there under these other options. Government restrictions are in place currently, and under a new ownership structure, there would be more flexibility there without those. And the last item here, market responsiveness, less likely for the as-is, more likely for the 501c3, and less likely for a for-profit, probably more on perception basis. Yeah, you could look at that 2 ways. I guess what I was thinking of is families maybe think a for-profit doesn't have as much staffing or as much, but definitely could be more likely as well. It depends on who your audience is. Table 25, or sorry, slide 25 summarizes the assumptions that were used in the financial models that are on the following slide. And this is based upon, we're looking at year 5 in the model, just because obviously there'd be some transition period. So we just kind of looked at year 5 and all 5 of the models here. The assumption was probably worst case scenario, the lower average daily census based upon the decline in the market. So we did assume worst case census at 162 or 80% in all scenarios. The fringe benefit percentage, as we've talked about before, there was another number in here, but that was from a 9/30 cost report. This 34% is from the June 30th financial statements. So in my models, I took that down to 27.8 for the other scenarios, and that was based upon the other chart for the Connecticut facilities in the area. Wage increases, I was given an estimate here of the 2.25% average wage increase, and I assume 2% for the other scenarios, just because those wage increases would go along with your rates, your Medicare and Medicaid rate increases, which typically are no more than that percentage. We talked about nursing staffing quite at length, as is. We left it at the current model. And we do have an as-is option B and option C, which is reducing those to lower staffing levels. And then the lower staffing level was also used in the other two scenarios as well. Their facility is currently getting some contribution and grant income, so that was kept constant. The assumption is that that would hopefully increase for a 501c3 and would be eliminated for a for-profit manager. If the facility were to go under a for-profit ownership structure, they would have to pay property taxes, which is estimated at $125,000. So that was included in that scenario. All of the nursing homes in Connecticut pay a bed tax. One of the benefits for the government ownership structure is a lower bed tax of $16.13, and that is based on per non-Medicare patient day. That number would go up to $21.02 under a different ownership structure. And then the nursing facility currently gets an allocation for services from the town. Inflated, it's 1.1 million, so it's probably around 1 million now or just below it. So that would obviously continue going forward. Obviously, under a new ownership structure, that would go away. But in place of that, I assumed a management fee of, I believe, 5.5% of revenue, which is standard in the industry. There definitely could be a scenario where it's not managed by an outside company, but then you also would have to go out and secure some of the vendors that they currently get services from the town. So there definitely would still need to be some kind of cost added in there. So right now, I'm just assuming a management fee for that.
So if I could just, so the bottom two lines, what you're saying there is the town's allocation of what we call in-kind services is $1.1 million. You're figuring that's going to escalate. That's fair. So that would go away, but we would have that 5.5%. That would be a cost to the town for the management fee.
Correct.
Let me see if I can help with that question. So that's legal expenses, HR, the whole 9 yards. What I think Mr. Simon's saying is if the town chose, we'll call it the sell lease to a 501c3, from a town point of view, we're not going to have one less attorney, we're not going to have one less person in HR, et cetera.
And a lot of it's the unamortized pension expense.
Right. And then our legacy costs are still going to be there for the cost. So I think that probably needs a flag there.
Okay, yeah, the comment is the allocation from the town's perspective would still remain on their books. Obviously would not get transferred to Nathaniel Witherall, but they would have to have those expenses would still be incurred. Which, yeah, that makes sense.
To clarify, some portion of those expenses. One can't say that from the town side that everybody agrees with the conclusions that were reached. Wouldn't go to zero, may not be 1.1.
Yes, so yes, the town would need to consider those costs going forward, I
And
guess.
just so I understand it, the management fee, is that, as you do the financial analysis, is that the fee that the new entity would incur to cover those services? Or are you expecting that that's a fee that the town would pay to support these new entities?
No. Yeah, just to clarify, the management fee would be an expense for the facility, not the town.
Okay.
That would be basically to replace those services.
I think it may be another way to say it. You had to put those figures in there. Had you omitted them, we would have artificially been making the two right columns look too rosy.
Yes,
You
had I
can't
not
say
added
that.
a
So
management
so
fee,
you
the
had to put
expenses
the
would be
costs
way
in
too
there.
low. Exactly.
Wouldn't want to overstate those two right columns.
right?
Yes, if anything, it's conservative. Yeah, you could not use a third-party manager, and the person could operate it without that. But I don't have the detail to know how many attorneys I need or how many what services I would all need to replace that. So that would pretty much cover that. Anything else before I go to slide 26? So slide 26 is the financial numbers based upon the assumptions in the previous slide. Again, just to clarify, the baseline numbers were from the June 30th financial statements compiled by PKF O'Connor Davies. Net revenues, it's pretty similar amongst the 5 scenarios, a little bit higher in the other scenarios. I probably used a little bit higher private pay rate increases. Total operating expenses, obviously lower under the other scenarios. We use the lower benefit factor, we use the lower staffing, so that makes up those differences. And obviously I made some adjustments as we lowered the census in year 5. I obviously had to lower the cost to go along with that. I just assumed a lower benefit percentage. I have to go back again and look at my wage rates. I don't know off the top of my head what I ended up putting in there, but I didn't aggressively change the wages. The benefits did go down and the staffing did go down, and then other costs did go down. I can get back to you on what I did for the wage rates. I think the assumption is that hopefully a new ownership structure would be able to negotiate better benefits and wages. Can I guarantee that? No, but that's obviously what would be the goal of moving to an ownership structure like that, and it's not going to happen overnight. So the scenario I assumed was actually a lease scenario. So what I'm assuming in this, and obviously different models can be run, I'm assuming that the new operator would lease from the town and pay the town $1.2 million, and then obviously the depreciation and interest would remain on the town. Obviously, if it was an outright sale, then that lease would come off and it would be replaced with pretty comparable depreciation and interest. No, that would be an addition. Management fee would be an operating cost. The lease would be to pay for the capital costs of the physical plant. A management fee would be paid to a third-party manager. It is funny, yes, it is coincidental. The lease payment and the management fee kind of worked out the same here. The question is, why is the depreciation so much lower on the second scenarios? That is because in these scenarios, I assumed a lease for the possibility, which would mean the person owning the building would carry the depreciation and the interest, and then the Nathaniel Witherall would pay that party rent, or a lease payment.
This page seems to be one of the most important, and I just want to be sure I drew the right conclusions. If we look at the net operating loss in the first column, the as-is scenario of negative $4.9 million 5 years out, and compare it with the either of the two right columns, I think the difference is $6 million a year. I mean, between losing $4.9 million and the town collecting $1.2 million on a lease. That difference is over $6 million. And so are we to understand that if the wages and benefits were right-sized and the staffing were right-sized, the difference is $6 million a year? Is that kind of an aspirational, is that what the numbers are
If all
telling
the
us?
stars are aligned, yes, that's the, as I would say, $1 million question. And just so you know, the 0.2 and the 1%, the margins, that's the state average. So I'm not just making this stuff up. That's what the average for-profit facility in Connecticut is running, and the average non-for-profit facility is running. So it is achievable. It's not
that's
pie in
helpful.
the
I mean,
sky.
you manage 34 facilities and consult all over the country. We own one, so we've hired you for your advice. I understand. And remind me one other thing. I think in your model, please correct me if I'm wrong, I think what you did was right-size the benefits and keep the wages. Isn't
I'm
that
pretty
what
sure
I think
will,
you did?
Yes, I'm pretty sure I did. Again, I will go
So
back
it-
and just make
So
sure
it wasn't
they didn't apply.
it wasn't overly aggressive. It was just
No,
it was
I
keep the
always run
wages,
my models very
change-
conservative.
Yeah, change the benefits only.
Yes.
That's helpful to know just how aspirational we are here. Thank you very much.
Just to clarify one conclusion, when you come up with the $6 million difference, you're not including the depreciation and interest that would stay on the town's books if we
That's
were
right.
the owner, so you've got to take that out.
Yeah, no, I'm not
Okay.
predicting what would happen to the debt. No one's talking about that here today. It's just operations.
And depreciate, that's after depreciation, the number you're picking up.
Yeah, the
And
debt-
that, and we would keep the depreciation, so that's another million. Anyway, but it's an
Happy to talk to you about
order
it.
of magnitude is large.
That's a margin, David.
I know.
I basically the industry. What I did is took the value times kind of the going rate for leases, which is like 8.5% to 12%. So I definitely I'm on the low end, to be conservative because I don't want to promise. But then again, yeah, they might want more. They probably want more for the building.
So in other words, it's theoretical, but who's going to want to, what private owner would want to do that deal? There's not enough margin for them to do it. It's a question, is there enough
Yes,
margin?
I can't comment on that. I don't know the need. There's definitely real estate investment trusts out there that are interested in skilled nursing right now. Can I, answer if they want this particular facility? I can't at this point.
That's important for the
Yeah.
right. It's not so important for the 501c3 because if they break even, that's fine too, right? But for the profit-making one, it seems unreal. It just strikes me as an issue.
So,
I'm not sure one could actually put an exact number, like the 1% margin thing for profit situation. I think it's probably a range.
So when you spoke earlier about the 5.5% of revenues management fee being standard in the industry, where in these numbers would we find that 5.5% management fee?
That is up in the total operating expenses.
Total operating expenses.
Where it's the 29, well, not that, it would be in that 24.9 and the 24.4 numbers.
So the point here is they get this 5.5% management fee and then the net income of 1%. So it's really like 6.5%. It isn't just the 1%, correct?
Very
That
good
David
point,
was
yes.
talking about earlier. So it's really 6.5%. It's not 1%, based on what we were told earlier in this discussion.
The comment was that the potential new operator would be getting potentially a management fee plus, I lost my train of thought.
Plus the 1%.
Yeah, plus the 1% margin,
It's
yeah.
about
The margin
6.5%.
plus the,
Aren't they paying the management fee to get in-kind services? They're not receiving
She
the
was
management
talking
fee.
about the new entity.
The new entity,
Oh, yeah, you're right. They're paying it.
the new entity is paying a management fee to.
She's assuming, I think in her scenario, she's assuming the manager is the same person as the landlord. So say ABC company comes in and as the new operator, they're getting the management fee plus the margin, is what she's saying.
Stephanie,
is
would
correct.
Would it be fair to say that these are just,
No.
as Dr. Patel said, these are just sort of scenarios to help us analyze where we are, and of course, the detail of each would have to do with the individual structure as well as the market at the time, right? So it's just sort of a jumping off point to start to understand the existing scenario versus
Exactly. I
other-
think it was just to bring to the forefront what different, I guess, things would happen to each different scenario. What would be impacted? What levers would be pulled under each scenario? Yeah, you definitely probably want to run. Anytime I run a model, there's 10, 20 versions and maybe 5 more sensitivity analysis. So, yeah, this is just the start of it. What's that? Exactly, yes. Correct, thank you.
Sorry to ask so many questions. Are there any examples that you have through your consultancy of municipal entities or otherwise transferring the asset to a 501c3? How common is that? How many instances are you aware of? What are the circumstances around that?
I can't comment on all the instances across the country, but we've done it probably half a dozen times from government entity to a nonprofit, and it works fairly well. And if we're ready to move on to slide 27, I can kind of give our recommendation unless.
Wasn't Stanford done? Was it a sale or the one in Stanford? Waveney?
It was, for profit.
I'd have to run that. I can't do that on top of my head. Sorry. I'd be happy to run that for you. Sure. Correct.
So you're saying the expenses go from 29 million to 23 million, kept the wages the same. So either you reduce benefits or you reduce staffing or you did both.
I did do both, and I did reduce non-productive time by a smidge based upon our large report. We had noted that that was higher. I'd be happy to give you the model. I didn't run every scenario and every dollar impact. I can't give you that off the top of my head, but we've provided all of the models and happy to provide that to you.
Because we don't pay that much in benefits in total, typically.
Oh, it's not all made up of that. It's mostly the.
Most of the savings is from staffing savings.
To find a benefit too.
Right.
And obviously helping the bodies too.
Okay.
You know, so what they're saying is not quite correct. And I'm going to profit change some of the structure of what we're doing.
Yes, there's definitely assumptions that you're improving your operational efficiencies, yes.
But the breakout of those two.
But the new owner is getting that benefit. Unless you do that, you take the as-is and do that concurrently with the as-is scenario. Could be, yeah, you definitely could run that model. You're welcome.
Question. In your main report, you mentioned that we would not likely get a fair market price with current losses and being a union facility. And you're saying that you're estimating the value at $65,000 to $75,000 per bed based on Connecticut's sales history. What would be the discount that you'd see, or is that the discount, the 65?
Yeah, I have another source that I did ask about pricing. I have some contacts that are in the broker side of things. And basically the statement was, we're not going to pay as much for a union facility. They just said on the lower end of that range.
So you would estimate it at 65 rather than 75?
Probably even less. I think they gave me a range of like 50 to 70. And then the union would be on the low end of the range.
Okay.
So we're running towards the end of our meeting, so if we could just try to wrap things up, and we'll do a little summation. You're pretty close to your...
Yeah, we're on the last slide. So basically what our recommendation is further examination of the seller lease to a 501c3. And this could either be an existing non-for-profit or establishing a separate entity. In the meantime, continue to make operational improvements. The 501c3 operator and the for-profit, as you saw, had pretty similar financial outcomes, obviously with the for-profit being more profitable. But the option that appears most sustainable for Nathaniel Witherall would be the 501c3 option. In this option, one other thing I don't have on the slide is it would be an easier transition between a government ownership structure and the non-for-profit than the complete flip over to the for-profit. We just see that being a more seamless transition. And when we've done that in our buildings that we took over, they usually were in a nonprofit ownership structure as well. And it seems to work out better. And one thing I did want to mention to consider, and if you do run your own models, I did not put any vacation payouts or any of that kind of thing that would need to be considered if there was an ownership structure change. So you would just want to look at those numbers as well. And then the town will retain the ongoing bonding obligation for Project Renew, which was the recent renovation of the facility. So just wanted to mention that as we kind of talked a little bit before.
Thank you. So I know that, first of all, thank you for the enormous amount of work that went into this. The full report, the appendices, and I believe the slideshow, although I'm not 100% about the slideshow, if it's not up already on the website, it'll be up shortly. But the full report and the appendices definitely up on the BET's website. So please, if you haven't accessed it already and you'd like to look at some of the backup and the detail, HCG's given us a lot to think about, both from demographics, market share, industry projections, specific operational concerns that the Nathaniel Witherall can consider right away, as well as potential strategic directions. And I know that it's a lot for the BET to absorb, as well as the Board of Nathaniel Witherall. So at this point, I think that concludes the presentation for tonight. And members of the public, if you do have specific questions, please reach out to us, and we'll do our best to either answer them or pass them along or get them answered for you, I guess may be the best way to put it. And then I do appreciate your coming tonight. Ms. Vasiliotis. Okay, all in favor?
Aye.
Adjourned at 7:17. Thank you.